guest and Professor, my tech member, Professor Namiraja Zarje. So, if you look at financial literature, line financial literature, basically, most of paper they focus about what is happening in corporate policy, like financial policies or corporate risk taking or investment policy or dividend policy. Most of paper revolves around this, and few paper revolve around the self-dealing transaction. Basically, Porta and other people, they have examined those things. But if you look at literature across globe and regulation across globe, most places, when it comes to related party transaction, they look from minority shareholder and majority shareholders perspective. There is no specific regulation. At the best of my knowledge, I'm not from law background, so if there is any rule, please let me know. I'll be more than happy. Okay. So, but in context of India, this is the first time when such rule is there, which tries to curb these related party transactions. It is not that every related party transaction they are trying to curb. There are few related party transactions which are abusive in nature. They are trying to curb those related party transactions. So let us look back first what is happening in legal domain. So if you look at law perspective from Companies Act 1956 onward, they are trying to curb this. Then again, if you look at Companies Act 2013, in that one also they have defined it extensively, and they said that you have to take board approval or sometime audit committee. Then SEBI came up with the listing agreement, and clause 49 also talks about this. So multiple regulation, but most of them they are taking care of interest of minority shareholder, not the creditor. So is there any literature in India? Yes, there is enough literature. This talks about minority shareholder and related party transaction. So, like I'll give you a few examples. So there is paper by Lee, which got published in Journal of Accounting Research, using Companies Act 2013. So they found that because of the voting rights which have been given in Companies Act 2013 to dissenting shareholder, it is not that only minority shareholder is having that right. It is dissenting shareholder which have the right to approve the related party transaction, but only if that transaction is materialistic transaction. Means if a transaction is of worth more than 10% of turnover of that specific year with a related party transaction, that need prior approval, like that need approval of shareholders. So in that that regulation is there. So they have found that in post period, because of this regulation, related party transaction have reduced. After this, Gopalan and Martin, again they wrote one paper in context of India. Up to 2015, what they found, whenever firm goes toward bankruptcy, so they do a lot of downwards earnings management, and after, when they file for bankruptcy, then they start siphoning the fund, because there is no specific provision to control that, this transaction. And another paper by Professor Parnesh Srinivasan is not here, so I was expecting that she would be here. Okay, so she has examined in context of India from 2009 to 2011. She has found that related party transaction reduces firm performance, and there is no relationship between related party transaction and ownership structure. So in general, this is what I have found in context of India, this literature. So why I am interested in these topics? Already a lot of things have been done, right? So let us look back again the literature. So if I ask you a basic question, what determines firm's response when there is improvement in creditor right? So simply we will say that there is increase in confidence of the lender, or there can be other side of arguments. So, but if you go back to literature, I try to know what could be possible reason why. Is it just the confidence? So what I found, there is personal cost of bankruptcy, which affects these things. Like, look, I can take bankrupt firm, then I can get to know that what is happening. So I looked at what is happening if there is change in personal cost of bankruptcy, because this is the reason, this is the driving factor. This determines every policy, how firm will respond. Like we say, non-bankrupt firm, they are also responding to because of IBC, there is behavioral change. So we have tried to know how this personal cost of bankruptcy can affect related party transaction. So, okay. Yes. So if you look at related party transaction, again I went back to literature. I thought, what literature says about related party transaction? Because we cannot say that stop every related party transaction, because there is because of related party transaction cost can be reduced. That the literature also suggests that. So if I divide the literature, there are two. One is efficient contracting hypothesis, which suggests that related party transactions are good and it should be allowed because transaction cost goes down. For example, let's assume I am a firm and one of my friends is also dealing in some business which are related to my business. So definitely I'll be having better information about his business if I'm doing some transaction in good faith, at least utmost good faith, or in ordinary course of business. So in that case, it can reduce my transaction cost and I can be more competitive. So this is one side of argument, efficient contracting hypothesis. Other is shareholder expropriation hypothesis in the literature, which suggests that parties involved in related party transaction just to defraud or tunnel the resource in the interest of themselves. If you are extracting some wealth in the interest of yourself, you are creating some cost for other parties. So yes, this is the reason why I am trying to understand, because both sides of argument is there in the literature. So I am trying to use this IBC as a setting where regulator want to control these related party transaction. So value of the firm can be maximized, which is also objective of IBC. Okay, this is a brief idea about my work, what I am going to do. Okay, so let us look at basic thing. Why do we own something? Like why there is ownership, concentrated ownership. So if you look at literature says that there are two important reasons why do we own something and why there is concentrated ownership. So if you look at Grossman and Hart paper and Barclay and Wilderness, they say that there is two reasons. One is private benefit, another is control rights. These are two basic reasons why we own something. So let us look, what are these private benefits? Is it just related party transaction or something else? So one of them is related party transaction, and most of literature they have talked about this related party transaction. And another is misappropriation of investment resources. Sorry, I have not cited on the paper. Use of transfer pricing and asset stripping. These are basic form of private benefit. So if there is extraction of private benefit, it will be cost for somebody. Okay. So let us go back to the literature. What literature says about private benefit? So whenever there is expropriation through related party transaction, this leads to reduction in value of firm and increases distress risk of firm. This is one, this paper, they have found this. And then what else literature says about this? Private benefit hamper the interest of other stakeholders, resulting in underdevelopment of capital market. So every regulator or every policy maker, they want to develop capital market. So even we can look at Bankruptcy Law Reform Committee, they have also talked about to curtail this related party transaction. What they said, this is necessary to guard against the siphoning away of corporate asset by manager who has knowledge of the company's financial affairs in case where a long period of financial trouble extending over a year end in insolvency. It means based on these things, we can draw the inference that yes, bankruptcy costs matter and like related party transaction matters, and there should be something done about this. We cannot live on markets. So next question comes, why do we believe that IBC will affect related party transaction? Simply people can ask this question. So to answer this question, let us look back pre-IBC period, what was there. So if you look at pre-IBC period, it was complex and time-consuming system that provide opportunity for the owner to extract wealth and protect their own interest. This is the paper by Gopalan, Martin and Srinivasan. They are found in context of India. Second thing, this was one report by Rajan committee. They found that moratorium period provide enough opportunity to extract the wealth. You file for bankruptcy, there is moratorium period, you can still extract the wealth. This was happening in pre-IBC period. So I will not go more about pre-IBC period. Let us look.
7 minutes.
Okay, sure. In post-IBC period, what is happening? Look, when bankruptcy filing will happen, transfer of ownership in case of default, will be like there will be transfer of ownership. Now existing owners will not be owner. Now a firm will be controlled by IRP or resolution professional based on behalf of committee of creditors. Second thing, if the CIRP starts, then all related party transaction will be re-examined for last 2 years. And if those transactions are fraudulent as per section 67, even before 2 years, they will re-examine. If these transactions are declared evident, they use the word evidence in the sense you can say abusive in nature, abusive RPG. So if those transactions are declared as evidence, they will be re-examined and appropriate action will be taken. Furthermore, if you are a related party, you cannot go for, you cannot propose for any resolution plan. You are not allowed. You don't have any voting right, even if you have done some financial lending to firm. So based on these things, we believe that IBC will affect the related party transaction. So there are two economic arguments. Whenever there is an increase in creditor rights, it will affect increased PCB, and increased PCB will force the firm, because now it is question of survival of firm. So firm will try to reduce this, so they will not go in default. So there can be reduction in RPT. On the other side, increased PCB might incentivize the owner that now there is nothing to lose. Let me extract as much as possible. Later on, we'll see what will happen with law. So that can force the firm to increase the RPT. So to examine this, we use the DID method. I'm not having enough time, so based on Scorner and Scorner paper, we have divided. We have classified firm into treatment and control group, and they have suggested that ownership concentration can be a proxy for PCB, personal cost of bankruptcy. So we have used DID method. So first of all, what we did, we asked ourselves how market has reacted to this law. If we are saying that PCB matter, so capital market definitely should react. So we took 12 events which were used in framing regulation. So we found two times it was significant. Like you can see, first event and event number 9. So first event, when IBC was announced like this, there was first announcement that IBC will come. And this one is when Lok Sabha passed the IBC bill. So we found significant in both the cases. Look at descriptive. Okay, I'll go directly in declaration. How much time I have left? Okay. So this is the main table. So we looked at our interest variable is IBC into own dummy. This is our interest variable. So in all these cases, if you can like first, second, and 3 total RPT, there is reduction in RPT in post IBC period. This is what we have found. We have control for firm fixed effect, year effect, industry year effect, everything we have controlled. Then again, what we did, we divided the total RPT based on Kolbeck and Mauer paper, which can be abusive in nature. We are not claiming that 100% those are abusive in nature. There is probability that these transactions will be abusive in nature. So they are having higher probability that they will be abusive in nature. So we are terming them as opportunistic RPT and other as business RPT. So business RPT, we can say that these are efficient contracting RPT. So the even law allows these kind of RPT, and opportunistic, definitely they want to curtail this thing. So we found that only opportunistic nature RPT has declined in post IBC period. So yes, because we have used DID, so there is basic assumption to test the parallel trend assumption. So we have used graphical method also, and because of slide constraint, we cannot use more than 12. So I have followed Prasanna Tantri's paper, and based on that, you can see that all interaction in all the cases, it is insignificant. This implies that parallel trend assumption hold. So, okay. So this is one thing. And after this, maybe you can say that there were multiple regulatory norms, audit committee changes, lot of 2013 regulation. So we have controlled like independent director, we have controlled compensation of directors. Everything we have controlled, non-financial factor also we have controlled, and we have not reported here. And what else we did? We look at firms having higher ownership concentration, and there is pledging of stock. because we believe that in those cases, because margin call risk is there. So this personal cost of bankruptcy will be much higher in those cases. So we have also found that these results hold in those contexts also. And again, there can be question of, functional form misspecification or covariate problems. So we have used PSM and we have found similar result. I have not reported it here. And yes, beyond that, we have also done few more like placebo tests to rule out other policies impact on related party transaction. Beyond this, most interesting thing which we found, we don't know why market is not rewarding, in the sense why firm performance is not increasing in post-IBC period. If we are claiming that RPT is reducing, opportunistic RPT, then why firm performance is not going up? Coefficient is positive, but we are not able to understand what is happening. So I'm working on that. Probably in future I'll see if something I can get. At conclusion, just I'll take one. Yes, our findings shows that RPT has decreased in post-IBC period. This implies that value of control now from like owners, they want to control the firm. Value of control is more important than private benefit of the owner. And there was reduction in only aggressive nature RPT, or you can say opportunistic nature RPT. And whatever legislator they wanted to achieve, they have achieved it. And probably this will help the policymaker to understand what is happening with them. Thank you.
So what is the proportion of opportunistic RPT in your sample?
Yes, I think I'll show you this.
So what is the proportion of?
Yes, I got your question. So you can look at this table. So almost opportunistic is just 5.4%. Because already there are multiple loss tries to come. So you cannot expect that it will be 20 or 30% of total loss.
And what is before and after?
Yes, it is there. So you can look at pre-period, it is 6.3, and in post, like, yes, sorry, 7.6 in pre-period, in post-period, it is 5.3. It is good. Any other question? Yes, yes, sure.
So whether the marginal use of capitals have improved post IBC because RPTs are not happening?
Great. This is one thing, like I'm trying to do this, examine this question in my paper, but methodologically, the way like marginal use of that capital, we have to go in productivity, right, to measure that.
Production
So,
function.
yes, yes. So I've not, I have made some mistake in computing that, because Akarbab model is most preferred model. I'm trying to do that, but still what I found in post period, we don't know why firm productivity is going down. It means
It's negative and significant. Over preference model.
yes.
It's negative and significant. And many of the papers, like, they are saying that productivity has gone up.
Productivity may go down
None
because-
of the results hold. The post paper, the first paper, which is one of the most, now most sought after paper nowadays, most of the other research is following their trend. And actually those results do not hold. If you take productivity as your TV,
Yes.
then you find it significantly negative. And students are doing it.
Yes.
Yeah.
So probably I'll look into that more.
Yeah.
Means productivity can be a host of other factors also. So that's why means how the marginal capital utilization is improving. That.
Sorry, I'm not gone in that much depth about that, so I cannot comment that much.
So you said that you have run some placebo tests.
Yes.
But I was just thinking, there's companies are really third, right? So they do not have this stricter enforcement of accounting and disclosure for RPGs.
Yes, it's right.
As 2030 in the Act came, it will be an impact you will see pretty much around 15-16. Right? But how do we sort of differentiate that impact as well as a concern?
Yes, so that's very interesting question. Even we are thinking, still we are thinking, we are not given 100% solution. But what we are saying, this PCD, this ownership structure, because in post-IBC period, these people were having more skin in the game. Like they have more to lose because of IBC. So probably these group will be affected more because of IBC. No doubt, what you are saying, they will also affect. But I believe that those regulations will be affecting equally this treatment group. And still, I do not have 100% accurate answer, but still, yes, I do agree. And I try to control multiple factors. Yes, yes.
So, I mean, one of our students, he was working on that, but he made an interesting point that whenever there is a statement in the domestic market, the international entities, really play the game. So maybe you can look into that direction. Then
Sure, so that's a good suggestion.
Sir, how are you taking the samples of RBT? Is it only public listed company or even private limited company?
Sir, in my case, I've taken just listed company. Listed company. Private company, I'm not examining.
So any other questions or comments, please?
Yeah, good evening. Good evening, everyone. So my research paper title is Sector Analysis of Effectiveness of IBC. This paper is jointly written by myself. I'm an insolvency professional also, and Disha Chobisa. She is a lecturer of economics. So this is the statement of problems. The corporate insolvency resolution process have crossed the timeline prescribed by IBC code, and for fewer cases, this is still continue without any conclusion for more than 333 days. The problem number 2 is there are huge haircut, and many media reports have alleged that IBC is used as a tool for haircut. Hence, we thought that this is essential that we analyze the resolution process and what are the recoveries to stakeholders. Also, we have observed that there are number of investors are limited in numbers, because one hypothesis is they are not aware what to be offered. Hence, we have also covered what relief adjudicating authority is allowing, and this may, the objective of this may attract more investors. These are the research objectives: to study and understand hurdles which cause resolution, and to identify any industry-specific attributes if there any exist in these delays. We analyze the resolution plan to understand sector-wise, industry-wise recoveries to various stakeholders, and to understand and understand sector-wise, industry-wise relief short in resolution plan. Research findings have also been divided into 3 categories in line with objectives. My voice is, I don't know, voice. Yeah, it's okay. So this distance is better. So these are research findings has been divided into 3 categories: the hurdle which close delays, and any sector specific attributes in that. Also the recoveries and what are the reliefs. This is the slide of the data which we used. For my analysis purpose, I have taken CIRP admitted cases till 31st December 2021 and their status as on 30th September 2022. So basically I have taken 70 days gap for the period is admitted. So the objective of 270 days, 180 days is allowed in CIRP, and normally NCLT allows 90 days extension without much questioning. So 270 days is a fair number for analyze the data. The CIRP data as on 31st December 2021 and status as on 30th September 2022. Few orders which were uploaded after 30th September but dated before 30th September has also been factored in this. So there were 4,946 cases were admitted in CIRP till 31st December 2021. Out of which 562 cases were withdrawn under Section 12A. We are aware that creditors can enter into settlement and the cases can be withdrawn if this is before the constitution of COC within with the consent of the applicant, and if it's after constitution of COC 90% of voting. So there are 11% cases where CIRP was withdrawn under Section 12A. In case of 14% cases, right, 714 cases, the CIRP was closed by order of Honorable NCLT, NCLAT, Supreme Court or High Court orders. Liquidations were ordered in 31% cases, and there are 32% cases which are ongoing continuously, and the 856 days average has been passed. So this is much beyond 180 days, 270 days, and 330 days prescribed by the statute. And registration plan was approved in 12% cases, that is 576 cases in 526 days. So this slide we have provided. Sector-wise, industry-wise, basically the cases has been divided in sector-wise, industry-wise to identify if there is any significant, any industry-specific attribute also exist in this. So this 4,946 cases, average days taken is 486 days. However, if you see the real estate sector, the number of days are highest, 590 days. Then there is a power sector, the electricity, water and gas supply sector, and then construction sectors. So as we try to find out what are the reason for this, and since the highest number of days have been taken in real estate sector, which is 590 days, the reason we could find out is there are various land litigations, higher number of stakeholders in the form of home buyers are two major reasons we could think over for this delay. Electricity, power sectors are, as we can see, the amount of claim admitted is significantly higher against the 478 crore of industry average. The claim in electricity sector is 1,550 crore. So this requires more investment in resolving these cases. Also, the value of these assets were deteriorated, which will be I will provide evidence for that in subsequent slide. And since there are lesser number of investors, lesser number of resources for resolving it, the times are significantly higher. The same arguments for construction industry also goes, and mining and quarrying industry also goes respectively. Basically, the higher litigation in construction industry and higher amount of investment in mining industries. In the next slide, we have provided amount sector-wise admitted claim and sector-wise liquidation value. If you see at the bottom of the line where the total has been mentioned, you will see there are, and these data are for the 576 resolved cases. So out of 4,900 plus cases which we have analyzed, 576 cases were resolved. These data are only for 576 cases. And I will request everybody to look at these numbers because this answers my question, my initial problem statement which says that IBC has been used as a excuse for haircut. What are the numbers is? So there were 8.85 lakh of admitted claims. These numbers of claims were admitted, and at the time of admitted liquidation value, the value of asset which was available for those corporate to realize was 1.58 lakhs. So at the time of entering into CIRP, the value of assets were already eroded. Only 18% of the assets were, if the alternative method would have been taken by the bank or financial institutions, only 18% of amount they could have recovered. As what is the conclusion of the site. And you can see there are significant dip in the power sector or mining sector where 8%, 10% is the value of the assets compared to that. So basically admission of claim indicates what is the amount of loan outstanding including interest, and the liquidation value is the asset value. In this slide, we have provided sector-wise recoveries also, the previous slide and this slide together. And we can see that recovery is 31%, means it's resulted to 69% of the haircut. In the next slide, we are just providing the combined numbers of haircut and the claim amount and recovery amounts. So, at the total, if you see at the total level, the liquidation value of asset for the 576 case which were resolved is 1.59 lakh crore, whereas actually the recovery is 271 crore. That means the IBC is actually performed well, performed over by 70%, like 170% is recovery. Had this not been done, had this been done through other alternative method is what we wanted to mention here. Recovery ideally would have been 18%, which will result in a haircut of 82%, whereas actually haircut is 69%. Then in the research paper we have mentions about sector-wise, industry-wise relief sought in resolution plan. We have categorized relief into two categories, the general relief and the sector industry specific reliefs. The objective what I am trying to achieve is, and also we have put in the recommendation that if upfront information is provided to the investor that these are the reliefs law will be allowing, there will be good chances that more investor will come. See what happened now, this industries are, there are lot bad has been already been told in the market about the industry. The new investor is worried whether I'll get this relief or I'll be, if I invest, I step into those industries, then also my name also will be bad, or regulators or SFI will also go behind me. So there is code is very clear, 32A section prohibited for new investors to action against new investors. We have mentioned the relief in the research paper, and the relief if we have to say, so there are general relief which protects new investors from past act of suspended directors under section 32A of the IBC code. The general relief also allowed the general nature like approval of change of names, shifting of registered office from one state to another state. Also we have seen that and the Honorable NCLT is allowed, rather directed to electricity board and those things, minor administrative work also, that to restate the electricity of the unit, which is actually essential. Few sector specific relief were also allowed, and we have mentioned sector wise in the research paper. If I have to mention about few of them, then in case of construction sector, the approval of the resolution plan provided that the corporate debtor, basically the new investor will coming in the shoes of corporate debtor and they will be running corporate debtors, and the resolution will only be successful if he is allowed to continue his business. So if it pass, the NHAI or PWD has blacklisted the corporate debtor, the resolution plan has provided for removal of their blacklisted, and also they have provided that if there is any delay in performance of duties during pre-CRP period to be excluded, and CRP period because the company is run by independent professional who is not from the industry, so those periods are also been excluded from the eligibility criteria. In one of the cases, the NCLT has also directed the Ministry of Food to allow, because the Ministry of Food has revoked, has cancelled the license for food park. They have allowed us to allow the new investor that food park license should be given. So this is the level of extent the NCLT has gone, the educating authorities gone and supported this. This information should be spread widely to the people, new investors, so that more people can come. So there are various wonderful platforms. 5 minutes? More? I need 4 only. So, and also there are few reliefs which we have mentioned in the resolution plan which were rejected by Honorable NCLT. And the logic which Honorable NCLT is given that they have power to decide on relief claimed which are directly related to resolution process and not to the future, because then people become creative and they ask anything from the NCLT, which is why the NCLT is mentioned that we will allow what is available. And few environmental related things wherein pollution board approval and these all waiver were asked for by the resolution applicant, which was denied by the Mandapur NCLT. This is the conclusion slide. So we are concluding that average time in resolution process is higher compared to what is expectations of the regulator, of the judiciary, of the lawmakers, and there are sector-specific attributes in that. Number two, the value of assets were already eroded at reaching the CRP stage. So merely saying that resolution plan, the IBC is taken as a tool to take the haircut is something which need a careful examination. More awareness need to be attract more investors, and upfront regulation on sector specific really would attract more investors in the CRP. In the paper we have also provided various data for average investment size and more information which can be used by the researchers for their benefits. So I'm done with this. I thank IBBI for providing all the information to us in this process. Yeah, I'll take the questions.
Sir, if you can kindly come to the conclusion of that slide. So just 2 points with regard to the first and second point. First point is the average time you have mentioned that is higher than expectations. So the IBC has provisions for 20 plus 90 or 20 plus 60 days, 330 days to be precise. So if you look at the average time taken for all the cases together, I don't think we are meeting that expectation. Like if we compare with the earlier regimes where it used to take 3 years, 4 years, 5 years, compared to that, definitely we are taking lesser times. But with regard to the set time deadline, I think we still have a lot of road to be traversed. First part.
Yeah,
Second.
In this we have not even factored the time which has been taken from the petition
Exactly.
to the resolution.
So that would, in fact, yeah, first point. So second point is when you're talking about the value of assets erosion while reaching at the CIRP stage. So what actually has happened in the first 2 years is that there was a lot of BIFR cases which have been languishing for years together. So when it comes to the IBC, we actually see that it's a dead rubber kind of a thing. There is no value of the assets. But what is more disheartening is that even after 6 years of implementation, where we thought that the BIFR overhang is already beyond us, we still see that there is a lot of erosion happening. So that defeats the very purpose of valuing or conserving the value of assets which we are yet to kind of achieve. So these were my basic comments. Thank you.
I expect that both quality.
We're still at a very preliminary stage, so all your comments, suggestions are very much welcome and very important. So why this paper? We started with looking at NPAs in the Indian banking sector, and what we saw, starting 2000s, NPAs were declining up to 2011, and then something happened. The NPAs shot up, and if you see this bank group-wise, public and private sector, you see that public sector banks have disproportionately higher NPAs. So the literature had some easy guesses. Public sector is bad, there's corruption, poor management, etc. But we found something interesting in our last paper. We found that the time when NPA shot up was coinciding with the time when commodity prices internationally crashed. Slippage out here is the flow measure of NPAs. It's addition to NPAs every year. Slippage plus restructured we have taken because you had forbearance period. And this was not a one-time incident. Even in 2008, when commodity price crashed for a bit, NPAs rose. And if you go back in time, in the late 90s as well, when commodity prices were falling, NPAs were rising. So, coming to the main thing, 2000 NPAs started rising. We saw evidences from other papers which talked about regulatory forbearance, AQR, zombie lending. We've countered all of this in the past. Zombie lending, I'll come to in this paper. But from this, we also model that between 2011 to 16, about 30% of the NPAs can be attributed to the commodity price crash. Now we got this result, but why did the prices decline in the domestic market? What happened? And even in these commodity sensitive sectors, not all firms defaulted. There were some which defaulted. So what was special about firms that did not default? So to look at defaults, We went to IBBI's quarterly newsletters and hand collected the default data. This is from 2007 to 2020, the amount of claims admitted. What we saw was quite interesting. About 44% of the claims were concentrated in one sector, which is the basic metals and metal products. So for the rest of our work, we concentrate on the metal sector and try to understand why this happened. Now, during the next 15 minutes, I'll try to explain what happens due to sectoral deflation, what were the causes of the fall in metal prices in India, the consequences. So, given that your costs are constant, a decline in your prices means decline in the sales revenue, which will lead to decline in operating profits, and therefore firms may end up defaulting. Like I mentioned, not all firms default. So why do some firms default? Or why some firms don't? The firms that don't, they may have either product market power or input market power. Product market power means your prices, you are the one who's deciding the price, so your price decline won't be affected here. So we leave that part for now. Coming to the input market power, there are three main types of input that a firm uses: labor, material, capital. Material, of course, if your prices in general are declining, you'll expect your material to decline, so your costs may decline. So that's not a big challenge. But labor, what happens there? We know that nominal wages are rigid downwards, and this, we figured, is very consequential for why firms default. We also see a little about capital, what happens to firms that are defaulting, and we figure there is some misallocation of finance. This is still very early stage, we don't have as concrete results. But coming to the data we use international commodity prices data from World Bank's Pink Sheet. We use trade statistics from UN Comtrade. We use CMI, Proves and ASI for firm level and plant level data. Other bank level macro data comes from RBI, NAS, MOSPI. For default data, we use IBBI's quarterly newsletters. And then for other firm level data, we use Proves. Now, sectoral deflation. Why did metal prices in India come down? So, we see that metal prices started coming down 2011 onwards internationally. This is the red line. There's free trade, so ideally metal prices in India should be the international metal prices multiplied by the exchange rate. So I did that, and I figured that the decline happened only after 2014. Why? Because between 11 to 14, your currency depreciated enough to keep the prices high. And if I see evidence from India, this is WPI basic metals, and I've also taken billet prices. Billet is a component in the iron and steel industry. We see that even this follows a similar trend. Prices started declining only after 2014, right? So what happens when globally prices are declining, but your currency is depreciating and keeping your domestic prices high? So for international sellers in the domestic market, they become less competitive now, right? So if they want to ensure that their market share is still holding in your country, they can now reduce the dollar price of the commodity that they sell. So what happened? China, which is one of the largest metal producer and which also who we import about 30% of our metals from, have taken the median unit price of imports in the iron and steel sector from China and from rest of the world. About 30% of our imports today in the metal sector still come from China. What do we see? Between 11 to 16, when prices were declining, you'll see that for rest of the world, imports from rest of the world were almost constantish between 11 to 14 the prices, and after 14 it declined. But Chinese prices were declining because China was able to keep their dollar prices lower when other countries couldn't. So to see the extent of this decline, what I do is I regress log of prices on exchange rate and see what happens. I've done it for China and rest of the world. A negative coefficient out here means that when your rupee is depreciating, Chinese are able to reduce their dollar prices in your market, whereas the rest of the world is not able to do that. And this is the reason why prices in India were declining. That was also a time when there were various policy measures taken to ensure that imports from China were declining. But of course, they had their way out. Even after adding on import duties and other duties, they were still more competent in our market than we ourselves were. In summary, this suggests that the decline in domestic prices post 2014 happened predominantly due to the very low prices of articles coming from China. And they were able to bear it. Now you say it's their government helping, their marginal costs were low or higher productivity, irrespective, they could do it. Now, coming to why some firms default, commodity prices have come down, it's happened in India, but why are firms defaulting? Literature talks about zombie lending, that our banks are lending to companies which are not going to repay your loans, and you know that, but you're still lending. But what do we find? We have tried to create a measure of lending to the zombie firms for every sector. This measure is based on 3 things: interest coverage ratio less than 1, higher than median leverage ratio in the particular sector. These 2 measures are commonly used in the literature. A third that we have added is negative sales growth for 3 consecutive years, because the first 2 measures may still have firms that are temporarily illiquid, but a negative sales growth for 3 years is good enough to show that these firms may not be wanting to recover their business or are too much into trouble. And what we see here is that I've taken this for 2011 and for 2014. So the darker bar is 2011, lighter one 2014. And ideally, if zombie lending is what is causing higher NPAs, then I should have higher proportion of zombie lending in the sector where you have higher NPAs. So like I showed you in the earlier graph, where metal sector had a very large amount of loans of claim in the IBPI database, we see that metals, the proportion of zombie lending is almost constantish, and it's about 8.5. Whereas you have other sectors such as computer, where it's gone up to 16, cement, where it's gone up to 11. So this made us question that is the zombie lending argument even valid, or is that just good sensationalism? We created another measure which is very similar, but for brevity I'll skip this. Now, which firms default? As I mentioned, not all firms default, they may be having specific characteristics. So jumping straight into the input market part, the labor market. Nominal wages are rigid downwards. So if I'm a firm and I'm in trouble, I may still not able to cut wages for my workers because they may not accept it. And firing is a big decision, as we see. So we try to estimate the monopsony power in the labor market for firms and see how a negative commodity price, see if there is a relation between their monopsony power in the labor market and a negative shock. We create the measure of wage markdown, and this is similar to the method that's used by Berger et al. In their 2022 paper. Wage markdown in simple words. Hello. Yeah. Wage markdown in simple words is a ratio of your competitive wage to your actual wage. So if my markdown is higher, that means I have a higher monopsony power in the labor market, that I'm paying lower actual wage than the competitive wage. So this wage markdown is dependent upon 4 things: your material share in revenue, wage share of output in material share of revenue, wage share of output in revenue,
and your revenue-based elasticities for labor and material. I've plotted the labor share and material share, both the mean and median, and as you can see, when you had a negative shock, which was the commodity price shock, after that the material share in revenue for firms declined, but their labor share of revenue still was increasing. This showed that firms are not able to cut their labor costs even when they were faced with a negative shock. Now I've plotted the markdown for sales deciles, and we see that the larger the amount of sales of a firm, the higher is their monopsony power in the labor market. But this does not go through when we do it using fixed assets. So a firm may have higher fixed assets but may not have higher monopsony power in the labor market. Now I've plotted the markdown, but how is this markdown even related to the default? So we plot the markdown for defaulted firms that we get from IBBI and for all other firms. We see that the markdown for defaulted firms has always remained lower than all other firms. That is, these firms have always had lower power in the labor market than all other firms. In fact, at the time when they were faced with a negative shock, their actual wages was almost equal to the competitive wages. They did not have as much labor market power at that point. We also try to estimate a logit model for default using the markdown, and we see that the coefficients are negative and significant. The first two columns are for 2015, and the third and fourth is for 2014. And it's negative and significant throughout. That is, if you have a higher labor market power, you are less likely to default. And as we see, the sizes do not play a big role in this. So firms having higher competitive wages compared to the actual wages, which is labor market power, are less likely to default, and we don't find a significant. This is a very preliminary graph of understanding misallocation of finances. It's still something that we're working on, and we're, a little apprehensive to put the results. But we plot the relative gain, which is a ratio of efficient level of operating profit versus the actual level of operating profit. So a higher point in this graph shows that the firm has more to gain in terms of operating profit, and it's actually doing bad. And we see that after the commodity price shock, the negative shock, there has been higher misallocation of finance. But it's something that we're still working on. So just to conclude, deflation has serious consequences. We're very involved in thinking about inflation right now. High inflation is dangerous, but deflation can be even worse. The decline in import prices from China was a big factor for decline in domestic prices. And this is important because steel makes up 2% of our GDP. And if you want infrastructure to grow, if you want economy to grow, then this is a sector which is very critical. Our research shows how there is importance of labor market power in the context of commodity price decline. And now that we know that commodity price decline can lead to NPA and there are other factors involved, it is very critical to design policies accordingly. Thank you.
Questions?
So one question I have: how the banks were lending is also a big question. Whether they were the collaterals were highly valued, they were not taking into account the cycles in the commodity prices. There also the inefficiency of the banks come because this 2013-14 period also coincides with the disinflation which Raghuram Rajan carried out in our Indian economy. So to large extent the prices of the commodity also crashed due to the disinflation. So maybe the bankers were also not taking into account the commodity cycle, price cycle.
Right. Interestingly, in the late 90s when NPAs were higher, then a lot of these new private banks that had come who had large NPAs, that was because of their commodity exposure. So ICICI had large NPAs in the textile sector, and that time the commodity prices had crashed. They also had exposure in the iron and steel, which led to large NPAs. We saw that after that, in the early 2000s, all these private sector banks started moving to more retail lending, whereas public sector was still lending to industries and a lot of commodity sensitive sector. So I guess that's why.
Then the covenants are itself faulty. Like they should look into more into earnings ratios, coverage ratios, rather than the asset prices. If this type of problems are there.
They could, but at the point where these loans were made, if you look, commodity cycle was at a boom. So anybody who looked at metal prices would have expected it to
because
rise
more
more.
of asset-backed collateral.
Yeah, I mean,
it also reconciles with what your earlier speaker was telling. Your liquid, so much amount of haircut was observed because so much of inflated price collateral was there. So somehow the inefficiency of the bankers come to the point.
May I just add one comment if time permits? So I think I should not be using the word bashing, but a lot of criticism the bankers have faced for many things. But as a counter argument, if I may put it like that, when you talk about collateral, right? So when banks supposedly lend against collateral, they are not looking. If you talk about steel, right? That is a primary. It's not a collateral. So the underlying, yeah, right. So when indeed if they are looking at collateral, they would be looking at the fixed assets part, or not the steel prices as such.
When the prices are going up, your assets are also prices, so the assets will also.
That is a primary security. That is the inventory or so-called the finished goods, which is although a part of security. But tell me one thing: if the prices are going down, can banks take their hands off and say, okay, we are not going to give any more, because that's going to be a cyclical problem. That's going to increase the problem. So I just wanted to know what better the banks could have done. I'm not saying that what the banks have done is right, but I'm just trying to think aloud. What could be the alternative that the banks could have done?
More of earning-based, ratio-based covenant should be there. So they overlook all those ratios and.
One policy measure that they may want to think about is like you have counter-cyclical buffers,
Which on a macro level the banks are supposed to keep.
Right. So maybe you want to have something like that for commodities, the commodity buffer, counter-cyclical commodity buffer. Strengthen your commodity exchanges so that firms are able to hedge their risks better. Maybe something like that.
And on top of it, the banks are also supposed to keep the risk-weighted assets in terms with the industry to industry, and also the exposure they have to different sectors. So that also adds. But having said and done, banks are still always exposed to some or other kinds of risks, regardless of whatever measures they take.
Thank you everyone for kind participation. So we conclude the session.
So thanks to all the presenters and attendees once again. So we had an interesting talk. So we conclude the session and we declare the session closed. Thank you very much. Thank you very much, Professor.
Sir, as a token of gratitude from IBPI's side, we want to present this memento to you. Hello. Okay, so we'll be starting now. Hello and welcome everyone to this technical session number 4 at the second International Research Conference on Insolvency and Bankruptcy. We have an interesting
Recording
lineup
in progress.
We have an interesting lineup of 5 papers over the next couple of hours or so. Chairing this session are Professor Sankarshan Basu and Dr. Kokila Jairam. Welcome. Professor Basu is a PhD from the London School of Economics and Political Science. He is currently the Dean of the Amrit Modi School of Management at the Ahmedabad University. He is also a faculty of finance at IIM Bangalore, where he has had a long tenure of over 20 years. He is extremely well published with research interests spanning financial calculus, option pricing, bond and portfolio valuation, applications of quantitative techniques to finance, insurance, reinsurance, risk management, and financial markets. Welcome, Professor Basu. Dr. Kokila Jairam is serving as a Joint Director in the Ministry of Health and Family Welfare. She is an Indian Economic Service Officer of the 2011 batch. She has previously served as the Deputy General Manager of the Insolvency and Bankruptcy Board of India, handling the CIRP division, and has authored many research papers on insolvency resolution. Prior to her stint with IBBI, she has worked with the Ministry of Commerce and Industry and with the Ministry of Rural Development. Welcome, Dr. Jairam. So now, we will be starting the presentation. For your information, each presentation will be roughly 25 minutes, so that's 20 minutes for the presenter and 5 minutes for Q&A. At 15 minutes into the presentation, we will be showing a time card, which will indicate that 5 minutes are to go. And then at the end of 20 minutes, we will be showing another placard showing that time is up. So now I welcome Dr. Elias Kapsis, who is presenting Bank Crisis Management and Resolution Legal Regimes in India and European Union, a co-authored paper with Dr. Niti Shila from the University of Bradford. Thank you.
Thank you very much. Thank you all for being here today, and it's a great pleasure and honor for us to join your event from UK. I'm physically here, but my colleague, Dr. Niti Shila, is from UK, so we'll be delivering both that paper, whose topic concerns banks and the single resolution mechanism created in the European Union. I will explain why we chose that topic. And the title lessons for India, I don't like it very much, to be fair, because each country follows their own, at the end, their own path. But the big issue in Europe, the issue of bank insolvencies, has been a very big issue in Europe. I will explain. There have been major financial crises. So they introduced reforms after the global financial crisis. They introduced reforms to try to address those problems, and that was a good opportunity for us to study the effects of those policies. And the EU, we selected it because it has incorporated the international, if you want, practices in regards to the resolution of banks. So that paper has 2 main parts. The one I will present based on the European Union policy, and one my colleague from UK, Dr. Niti, will present, which is about India. Just some background for the 2 speakers. I am an associate professor of law in the University of Bradford in UK. My expertise is in bank and finance law, and in that case, in the case of insolvencies, I'm interested in the insolvency and resolution of financial institutions. My colleague, Dr. Niti, is expert on insolvency in general, corporate insolvencies, and she had joined me and I joined her on this project where we try to see how we can build a more effective, potentially to make proposals for a more effective framework for the resolution of banks. Primarily for India, but also for back home UK and EU. So this paper, therefore, quickly I have already given you an outline. So we're going to look at the crisis management and resolution legal regimes in India and the EU, and we're going to draw from the EU framework, mostly because India did not face the kind of crisis that Europe faced. So it's a little bit lagging, I would say, in regards to the adoption of framework for the resolution of banks. EU, on the other hand, was forced to act fast after the financial crisis, and even later because they faced also a sovereign debt crisis. So they faced multiple crises, so they were more active in this area. On the other hand, that framework has been already enacted for more than a decade now. And the purpose of this paper is not to describe or to analyze or to comment on the structure, on the framework itself, but to see from the practical implementation what are the pros and cons, if you want, some lessons that we can use from the practical implementation of those of the EU approach. To give you a little bit of context, so in India, when the global financial crisis hit back in 2007, 2009, the impact of that crisis was minimal for the economy, limited exposure to riskier assets as well, and derivatives were from where the global crisis started. And India had some, obviously, its own, if you wish, banking issues, which were more to do with credit and liquidity squeeze, but it was not direct hit from that crisis. It was, if you want, an aftershock. So there was reduced access to international markets at the time in these areas, and there was some impact on external trade. We're referring now to the period of 2007-2009, when the financial crisis hit also, if you remember, there was also economic recession that followed. So India was affected mostly in regards to its external relations, trade relations with other countries. So today India faces pressures from a different type of problem. The bad debt in its banks, where the official non-performing loan ratio is 9.6%, and the ratio of stressed assets, which also includes restructured loans, is 14%. That's higher than currently in EU. And even in EU during the crisis, so they didn't have that level of high bad debt in EU at the time. They had different problems, of course. Now in EU, on the other hand, I mentioned already there was serious crisis, first starting with the financial crisis, the global financial crisis. During the period of 2008 and 11, EU allocated 4.5 trillion euros. That was equivalent to 37% of the EU GDP at the time, for state aid measures to support, to shore up the financial sector. So it was a massive intervention made. In addition, that was only to shore up the financial sector. In addition, they had to support the economies as a result of the economic recession that followed. So the measures increased the government debt ratio from around 60% of GDP before the financial crisis to 87% after. And for some European countries like Greece, Portugal, Ireland, the debt went far higher. As a result, the region experienced a second round of crisis between 2010 and 12, which was sovereign debt crisis, which again hit the banks for a second time. So it was the global financial crisis. They tried to stabilize the system. It happened, but then they spent enormous amounts of, let's say, state resources to shore up the financial sector and support the economy, and they ended up having a second round of crisis, this time around national debt. So that was the result, the situation, the context which forced the EU at the time to act quickly and swiftly to change the framework pretty much, because the crisis proved, you can see from the figures, that they were not successful before the crisis. If you have to spend 37% of your GDP just to support your financial sector, this indicates a serious problem with the framework for the resolution of banks. And so the reforms that they followed after the financial crisis, they were not EU tailored to EU. They followed the financial stability boards and other international banks and Basel Committee recommendations and standards at the time. So one of the major problems therefore they discovered is they can no more afford to bail out banks using taxpayers or public funds. So they needed also to prevent the problem before it becomes a major issue, because one of the reasons there was that amount of, let's say, financial support there was because they failed to stop the contagion when the crisis started. So they needed early planning to prevent the contagion from even starting in the financial sector. So they needed to improve the process of preventing those failures. Then they needed, because the public was unable, the state was unable to financially support, to provide all the resources needed to restore the viability of banks, they needed the private sector to contribute. And then they found that insolvency rules, traditional insolvency rules, corporate insolvency rules would no more work for especially those very large banks, the so-called too big to fail banks. So they needed a special resolution regime for them. That was not the EU's, by the way, it was findings of the global experience after the last financial crisis. And the EU, of course, faced its additional, we said, crisis and pressures from their own internal problems. So India does not have to this day that kind of pressures, but I think EU is a good opportunity to see what actually happens if these measures help, because India is heading in the same direction. They try to join other international standards or frameworks that comply or not comply, are aligned with those international practices, and it's good to see how these international practices work. On that moment, I will pass it to my colleague, Dr. Niti, who will speak about the India process towards, let's say, revamping the framework for resolution of banks in India.
Thank you, Elias, and a very good morning to everyone. Just to give a little context to the study, 3 years back, I did a funded research for the Ministry of Corporate Affairs, where we looked at the FRDI bill. At that point in time, when we were doing the research, the government had decided to roll back the FRDI bill and put a new framework in place. So our exercise was basically focused on to study the FRDI bill and find out where the gaps were as compared to the key attributes provided by the Financial Stability Board, and see whether we are aligned. Surprisingly, we found in our study that FRDI bill largely aligns with the FSB key attributes, and based on our study, we sent a recommendation to the government to reconsider FRDI bill, of course, with some tweaks and changes. And I'm happy to share that government did put our consideration in place, a suggestion in place. Now, this project basically emanates from where I had left that study, to see that if we have to introduce FRDI bill, what changes we need to bring in there. And in this context, what Elias said becomes extremely important, that if you're looking at the single resolution mechanism as FRDI has suggested, probably it's right to try to look at EU laws and see where the tweaks could. So now that I've given the context of of the FRDI, one has to remember that the biggest controversy regarding the FRDI bill was with the bail-in provision, which will come back in later. But FRDI bill probably marks the first initiative by the legislature to align the Indian framework for bank resolution as close as to the international best practices. It proposed for a single unified framework for resolving certain categories of banks. The focus of the law was largely on banks which could cause systemic risk to the system. The bill provided for basically two resolution authorities, and it provided that the banks which were systemically risk, which could cause systemic risk, basically falling in the category of causing material or imminent risk, they had to submit a restoration plan. Restoration plan basically focused on how the bank would deal with crisis if it occurred, and the timeline provided for submission of this plan was 90 days, which is within 3 months. And within the restoration plan, it was expected that the bank would give the details about the assets, identify the risky assets, and also lay down its contingent liabilities that it had. And based on the liabilities of the bank, the restoration plan, they would propose a scheme Interestingly, what also was provided under the FRDI was that in event there is a material change from the time the restoration plan is submitted and and the time it's reconsidered to bring in, to execute it, any such material changes would have to be informed to the authority, resolution authority. Very quickly, the few options of restoration was either by transferring the part of assets or liabilities based on the agreement that the corporation and the such person had. Second was either to create a bridge service provider who could hold on the assets in interim. Bail-in was also one of the options suggested. Merger and amalgamation has been one of the methods of restoration even before the Insolvency and Bankruptcy Code came in, and it was reiterated that under merger and amalgamation or under scheme under Companies Act 2013, it could be, it could simultaneously adopt that measure. And acquisition of specified provider either in whole or in part. So the part sale was also allowed, was one of the options. And of course, the final option was liquidation. In event none of the above could work out to restore the banks, the bank could go for liquidation. So what the FRDA provided was that the banks could adopt any or either or in combination of these schemes. So yeah, Ilyas, let me hand it back to you on this. Just before Ilyas takes forward, a quick look into the FRDI bill shows that there were some gaps with the FRDI. The first gap was the very initiation of insolvency. It was not clear as to who could start the insolvency process against the FSPs. Even though the insolvency process against banks could be initiated on the application filed by appropriate authority, appropriate regulator, which in this case would be RBI, what was unclear was that what would be the considerations for the NCLT. We have seen in past that under IBC, any such uncertainty in terms of law has a huge effect on the timeline of the resolution. Also, there was risk regarding the resolution option, the right resolution option, some guidelines providing as to which one the bank should opt. And most importantly, I think I'll just stop with that, was the bail-in provision. I think it was more of a political, it was a real issue combined with a lot of politics around. Bail-in shifts the risk and the cost of the resolution, the restoration, onto the to depositors. Interestingly, the depositors, the threshold, let me put it this way, that what FSB provided that depositors are insured against such contingencies, and in India the threshold, the deposit insurance amount was very minimal, and it was again one of the areas of issue with the bail-in. And on that, let me pass the floor back to my colleague Ilyas.
Thank you. Thank you, Nitin. So moving on, so what you created was a centralized system, first of all. You realize that if you have a very large banks, you need to have a centralized response if something goes bad with those banks. We're talking about the so-called too big to fail banks. Then they decide that these have to be subject, as you said, to special regime, separate from the others. The other banks will be sent to insolvency and liquidation, usually at the end. But for banks, they decide that this should be, for large banks, this should be the last resort. Because the new element that was added here was the element of financial stability they need to maintain. And sending banks, large banks to liquidation seems to be creating more problems than it was resolving. So they created also separate bodies, specially authorized, Single Resolution Board and whose role was exactly to do that, to manage the process centrally and in consultation, of course, with all the member states of the EU and the local markets. Now, due to lack of time, I will move on quickly. And again, there are three stages, if you wish, in the process. First, we're dealing with bank recovery plans, which the banks have to submit before even problems appear. Should be there in case things go, there are some negative developments in the market for them, so they need to have in place recovery plans before everything happens already. And of course, they have to respond to those plans, to those potential scenarios, by acting now for something that might happen in the future. Part of the problem there, of course, is we're talking about scenarios now. You are working on scenarios that if, for instance, financial situation of a bank deteriorates, what they have to do to get back to health. Then if this fails, they need to have a resolution plan in place, which contains a list of options like the one similar to the ones described by my colleague Niti earlier on. So we have the resolution plans, which the banks have to submit again before, and to act upon those plans already means to make adjustments to their business models now before the resolution kicks in. And if, of course, when the resolution problem appears, or when the resolution trigger appears better, then the plan will be there to tell the authorities and to tell the banks what are the next step. The biggest problem there, of course, is that again you are planning for the future based on uncertain market developments, and then whether the bank is resolvable, for instance, because they do that evaluation. If it can be resolved, we save it. If it cannot be resolved, we send it to liquidation. Again, we're working based on scenarios, which is the second problem. Working on scenarios based on evidence which do not exist, but to try to speculate, to try to guess about the future, that is part of the problem. Now, in the last 1 minute I have, I will move on and say, to summarize what were the key lessons from the EU experience. Centralization is a good thing. Large corporations, large banks, you bring them together. So resolve them as one through a central control by a single resolution authority. That's okay, but you still depend for collection of information to local authorities. This may create problems. The data is a big problem there because banks do not always submit truthful data. So you need the data, you need them to be in real time if possible so as to decide. Then the recovery and resolution planning, already said, you're working based on scenarios. So you plan for future scenarios, you make adjustments to the business model just in case things happen. If they don't happen, there is a cost for the banks because these do not come free. Finally, you have the selection of tools, as my colleague Niti mentioned, it depends. And I'll finish, so it depends on how the authority will decide to play with these tools. And then you have the interest, of course, the issue of resolution and insolvency, two different banks, but subject to two different procedures. And of course, the bail-in controversy that my colleague already mentioned. We'll stop here. Thank you very much. Apologies, I think run over by a minute. Thank you.
You open the floor for questions.
I just have one question. I mean, you drive significantly from the EU experience, but the microstructure out here is very different, and the cost of a bank failure out here is way higher than the cost of a bank failure in EU. How does that get accounted for?
Basically, what we're trying to see is we're trying on the methods. Okay, so the planning, for example, again, you have to plan like a restoration plan, right? So different environments, but again, you're working based on scenarios. One of the common problems, for example, is the data. You need accurate data, you need timely data, and you need also true data. Okay, that's part of the problem. For example, that both countries will face. You may say no, but I have a feeling, I mean, traditionally in the financial sector, that's a major problem, how you collect accurate data from the banks. Because the biggest problem is regulation is always there, but bank failures happen. Okay, so part of the problem they found was this. Another problem was, again, I don't want to use the term politics, but it has to do with internal conflicts of interest between regulators, between banks, between the interested parties. I mean, the decision of which tool to use, for instance, if you want to send the bank to liquidation, if you want to arrange a merger through a breach or other option, if you want to use the bail-in tool, these are decisions for which at the moment there is no standard way of knowing in advance. The decisions become unpredictable. So again, I think it's a similar problem that you will face, because again, we're talking about from an economic and market impact perspective. So there are some common themes, therefore. These are the ones we're trying to find. So areas where there's opportunity for convergence. Of course, other areas where there's no opportunity for convergence, we leave those outside.
The system of banking we follow in India is mass banking, whereas in EU it is unit banking, single office, because bank failures are common in Europe, but in India we have number of branches. Even after we have seen so much of money was in fraud by many of the big willful defaulters. Not many banks have failed per se. So when you take the structure, market microstructure, there it is unit banking, here it is mass banking. So how do you, I agree that you are taking the common things which could be tried in India for this bank insolvency, but we have never seen any bank going insolvent. We are always saving them. And they are not actually so poor that if in one branch it happened so many crores, like in Nirav Modi case or Vijay Mallya case. But none of those banks have failed. We have bailed them out. Maybe I agree with that bailing, that is a debatable thing. But given the structural differences, how do we take this forward? Thank you.
Thank you. The only brief comment is, yes, that's correct. I mean, each market has its own structure. The US has its own, other countries have their own. At the end of the package of tools they have available, let's say bailout, to put it another way, using public funds. This has become a big issue. You may not allow them to fail, but you still have to support them. That's, as the banks grow, and they will keep growing in India as well, maybe not to a scale like, outside, but there's still an issue if it's worth saving them using public funds or if we should encourage some other arrangements. So, I mean, the bad loans, India has higher rates of bad loans than EU has at the moment. So again, the issue is different markets, but again, similar problems, if it makes sense. So it doesn't mean you will follow the same solutions, but you're facing the same, sometimes the same problem, right? Different solution, different context, but the options usually are the same. The tools, bailout, bail-in, broker sale, all those are similar, in most jurisdictions now. It's just about how each country decides to use them. So there are some, in my opinion, in our opinion, some common things, and some others, as I said, where the two jurisdictions are not close at all. Thank you.
Yeah. And just quickly to step there, and one has to remember that the effort of the government is to harmonize and bring close the domestic laws as close as possible to the international best practices. Now, having said that, FSB report has provided and it has been in consultation with the RBI to provide for insolvency framework. Sadly, IBC does not cover the insolvency resolution of banks, neither is it fit to cover. So if you look at the Indian landscape, there's a complete vacuum of framework for insolvency resolution. And what happened during Prudential Framework June 9 circular in past was a very quick fix approach. It's not it's a go-to approach. We do not have laws in place. So now coming to the question, what kind of laws? Should it be the EU model? We do not suggest a model. Two things we have to be mindful of, that India has to align as closely to the FSB guidelines. And second, because though there's a one size does not fit all, there has to be some standardization in approaches to addressing insolvency. Second thing what we see is that looking at the FRDI bill, there were gaps which could be addressed, but it was one way closest to the international best practices. Coming to the cost of insolvency that the previous gentleman asked, I can't see you, but let me just take a very quick liberty and ask in 30 seconds that this is exactly what we suggest, that the cost of insolvency, address a resolution, maybe, it's not the cost of insolvency they look at, it's the larger the cost on the economy. And I would say that the cost on the economy is equally, critical and equally visible in both the economies. And though we may not have that kind of the big size of banks in India, but I think we're almost there. Look at the, gross NPA, rates in the developed economy. It doesn't go beyond 1.2, and India is aspiring to be developed economy with, with a almost static rate of 9.6, which is not a good thing for India. So I think moving forward, what is the way out is we are saying, and what Ilyas and I suggest is, these are the tools we could maneuver around and see what works best for our country. Thank you.
The time, I don't know, the chair.
Yeah, I think we need to move on. Yes, yes. So thank you.
We will continue the discussion, obviously, offline over lunch.
So thank you, Dr. Yes, and Dr. Nitishika for this wonderful presentation. Now move to the next presenter for the session. We have Srinivasa Samanandava, who will be presenting environmental themes under insolvency law, concepts and challenges. Who author paper is Dr.
Yes, so I'd like to thank IBBI and IMB for having me and allowing me to present. So, yes, as was mentioned, we are going to present on the topic of environmental claims under Indian insolvency law concepts and challenges. So, yes, I mean, as we go, I mean, we've put this paper as a working paper on IMA's website. So, I mean, a quick Google search will also enable you to access the full paper. So, as we start, I mean, what did we actually want to uncover in this paper, and why did we want to study environmental claims in insolvency? So, I mean, there have not been any environmental claims as such faced in CIRPs in India. But why is it relevant? So, I mean, the World Bank had previously the Ease of Doing Business Index, which it has now abolished or stopped in favor of a new index, that is Business Enabling Environment, that is BE index. So in the preconcept note in the BE index, the World Bank in the insolvency resolution indicator or framework, they very specifically said that they would also examine how environmental liabilities are treated in insolvency. And I think this is a conscious shift because of the importance of climate or environmental obligations of a company, and hence this assumes greater focus or greater context. So yes, I mean, because there were no claims so far in India and elsewhere across jurisdictions, there have been certain clashes or interactions, if you may, of insolvency and environmental obligations. So we also did examine that, and well, I mean, as the presentation goes on, we will touch upon that as well. So therefore, we wanted to study how environmental claims are treated under specifically Indian insolvency law, and we engaged in a comparative analysis, and as most legal research follow, doctrinal methodology as well. Yeah, so I mean, one of the best ways to understand what the issue is at hand or how does it play out is to take an example, because I mean, law can be confusing and complex. So let's just take a simple example. Let's assume there is a company whose revenue focuses or is generated by a chemical plant, and there is a accident that occurs at the chemical plant which causes some pollution, and this pollution results in many types of issues. That is, it pollutes the rivers, the water bodies, the environment, causes certain health issues amongst the people who are living nearby. And because of this, the company's license has been suspended, and the Indian Insolvency and Bankruptcy Code adopts a cash flow test. That is, they look at default. So because the company's cash flow is facing problems, the company defaults on its debt obligations to various creditors, and one of the creditor files insolvency application with the NCLT. So now this is a very possible scenario that can occur, and in this scenario we need to understand how environmental claims or environmental liability is treated under insolvency. So just trying to understand, or just recapping how the waterfall mechanism, which is the distribution of funds in a resolution process, occurs in India. So this is just a table where we can see that first, okay, and also it's a hypothetical distribution. So we've assumed that the company has 100 units, and these are just assumed units, just to illustrate the issue at play. So therefore, as we see, the sixth priority, that is any remaining debts and dues, those are most likely to include environmental claimants, and we see that financial creditors or secured creditors, who almost always are financial creditors, are given high priority. So that is second priority. Again, it's a complex procedure where a financial creditor can relinquish their security and get higher priority, but nonetheless, though all the financial creditors are included above other debts and dues, which is a residuary clause. So now going back as to who would be these environmental claimants. So yeah, environmental claimants would be anybody who is adversely affected by the environmental liability or the pollution that arises and is caused by the company. So as I previously mentioned, they could be polluted, I mean their farmlands could be polluted, their borewell could be polluted, or they could also have health claims or health issues at hand. So now one key feature of the IBC is that it initiates, or it automatically triggers a moratorium on all other cases once IBC or insolvencies, once the company is admitted to the insolvency framework. So now we can assume in a scenario that where there is immense pollution, that there would be cases which are pending before the court for determining the amount of compensation to be given to such environmental claimants. So once a moratorium comes into play, these claims become contingent claims. That is, they are contingent on the outcome of the case. So therefore, we can classify them as environmental contingent claims. And let's assume that some courts or some adjudicatory forum, which I'll also come to a bit later, has already decided on the claim and has given an order against the company. So those would be decree holders or environmental decree holders. Now the Tripura High Court in judgment had said that decree holders would be other types of creditors because they follow adversarial process, and IBC aims at resolving companies. So in that regard, the Supreme Court also upheld, I mean, they did not entertain an appeal, so therefore they implicitly upheld the judgment. So therefore, environmental claimants, as we just saw, would be of two types, either contingent claimants or decree holders. And now going back, I mean, we can see that they are even below government dues as well. So again, now I'll at the very end touch upon proposed draft paper in which they have proposed some amendments to the waterfall mechanism, but nonetheless our concerns would still remain valid. So yes, now there is, I mean, the case of Swiss ribbons, the Supreme Court held that claimants under the waterfall mechanism would not be legally obliged to get more than the liquidation value. So let's say a company's liquidation value is 100, and in case of liquidation, the government would not have gotten any, would have not recovered any claims, or similarly, there would not be any recovery for operational creditors as well. So in that case, they would not receive any compensation, or they are not legally obliged to receive any compensation. Traditionally, we have seen that it depends on the discretion of the resolution applicant, who sometimes gives some nominal amount to such claimants. So yes, what does the data tell us? So again, This is data till June 2022 of successful resolution, companies that have been successfully resolved. So in this, it tells us that the liquidation value, so let's assume if the liquidation value of a company is 100 units, the financial creditors have on average a claim of 178.8 units. So therefore we can see that it is very unlikely that other claimants would be legally obliged to get anything. And just a few facts and figures as well, that they receive 33 cents, the FCs receive 33 cents on the dollar compared to the OCs who receive 11 cents in case of successful resolution, and in case of liquidation they receive 11 cents, the FCs, compared to the OCs who receive 2 cents. So again we can see liquidation is not a desirable outcome, and there are only very few instances of contingent liabilities or contingent claims even being recognized. So I mean, there was this case or resolution in Bhushan, so it was in the case Punjab National Bank versus Bhushan Steel and Power, where the resolution plan accommodated for contingent claims, but they only set aside 35 crore for contingent claims and they capped all claims at 10%. So that is, if the court decided, let's say one contingent claimant was to get 10 crores, under the resolution plan they could only get 1 crore because the claim was capped at 10%. So this is how contingent claimants are generally treated, and well, it's so yeah. Now one may say that, well, insolvency is undesirable outcome, undesirable scenario, so tough luck. I mean, in insolvency the debts or what is asked for is far greater than what can be given. So in that regard, I mean, what can be done about it? So just a few things we need to acknowledge. As yes, we acknowledge that IBC is an undesirable scenario, or insolvency is an undesirable scenario where, of course, not all claims can be fulfilled, but giving low priority to environmental policy or environmental claims overrides the environmental policy to a certain extent, which says that the polluter needs to pay. So for instance, going back to the example, in that example, immediately the government would come, clean up, provide aid to people affected. So now the cost incurred by the government in cleaning up and providing immediate aid generally is to be paid by the polluter. So in this case, it increases the fiscal burden, and it is to a certain extent, I mean, something like a subsidy, or even when you extinguish government dues, it becomes subsidy, or maybe even some may call it a partial bailout. Now again, there was some discussion regarding bailouts. So we do not cover bailouts. Bailouts is not in the scope of our paper. But again, we just acknowledge that the BLRC, while drafting the Insolvency and Bankruptcy Code, had consciously said that yes, we want to move away from the mindset of giving credit only against security, and we want to ensure that the credit environment improves. So in this regard, this can be a conscious decision by the government that yes, we are going to give preference to financial institutions to recover whatever they have invested in, because we want to encourage providing or the institutions giving credit. So again, this is economic policy. So this is something we acknowledge, but again, there's a wider debate that can occur. We do not cover that in our paper. However, very interestingly, we see that if we go back to the waterfall mechanism, we see that workmen dues are given high priority. That is second priority just after insolvency cost. So in this regard, workmen dues are given high priority because there is a direct and visible adverse human rights impact. And also we could see that trend, I mean, implicitly being acknowledged or recognized where home buyers were treated as financial creditors, because the court actually went forward and said that yes, home buyers there's a dream to buy a home, to live in a home, and they've invested so much money. So therefore, I mean, there is a visible and direct human rights impact where insolvency overrides environmental policy. So, I mean, yeah, this is something the IBC acknowledges and may have consciously acknowledged giving high priority to workmen. So, I mean, one obvious solution comes up, why not give higher priority to environmental claimants? but this is something similar to opening a back door. And then there would be n number of special interest groups that say that, well, you gave higher priority to environment claimants, we want higher priority as well. So for instance, take farmers as operational creditors. So there is one case in which the resolution plan, it was restructuring of a sugar mill, an insolvent sugar mill, where farmers or sugarcane farmers were operational creditors. And the successful resolution applicant came in and said that, well, I'm going to give 100% of the claims to farmers, but I'm not going to give 100% of claims to other operational creditors. Now, according to whatever has been decided, there needs to be pari passu treatment or equal treatment among classes of creditors. That is, you can't treat one financial creditor with higher priority than another. You can differentiate between classes of creditors, but not in the class itself. So even though very interestingly the NCLAT allowed that resolution plan, saying that commercial wisdom of the COC should prevail, because the COC said that, well, I mean, if we don't pay back the farmers, they'll not provide us with sugarcane. So the successful restructuring of the mill makes no sense if we don't get sugarcane to produce sugar from. So therefore, I mean, something like that, where special interest groups come forth and say that, well, we also want high priority as we deserve. So therefore, it's opening a back door, and where differentiation, or where one of the motives of the BLRC in drafting the IBC was to avoid such a scenario where banks would get lesser credit and therefore they would be very paranoid perhaps to disperse credit without security or something similar. We should not ideally, I mean, open this Pandora's box. So therefore, what's the solution then? So in India, we have Public Liability Insurance Act, which had come across because of the Bhopal gas tragedy, where I mean, the government said that you need to mandatorily have insurance if you're handling hazardous substances. So, I mean, I'll explain the process briefly. Under the PLI, the collector makes a determination on the principle of no fault liability. That is, it doesn't determine the liability, rather determines the act itself and then provides compensation. So, I mean, insurance can be an answer, and PLI indicates the answer where insurance comes in and resolves the problem created. So now, I mean, just as we touch upon insurance as the answer, why cannot we seek the answer in insolvency law? So in this, we need to acknowledge and recognize the limits and logic of insolvency law. So insolvency law, I mean, Thomas Jackson, describing insolvency, he describes insolvency as a series of debt collection laws, and says that when insolvency clashes with some other law, why do we actually want or examine insolvency as clashing with that other law? So what Jackson indicates is that insolvency is an outcome or a consequence or a symptom. So rather we focus on the cause itself. So can we do something about the cause? Because in insolvency, of course, undesirable scenario, debt is greater than what can be provided for. So therefore, this is the limit of insolvency law. So therefore, if insolvency law does override, let's say, environmental policy, we can't say that, well, we need to give environmental policy higher priority. We need to holistically try and understand the motive of insolvency law, the objective it tries to achieve, and then see that if there are other methods and ways we can try and accommodate that environmental concern or environmental policy. So for instance, insurance in this way becomes the answer. And yes, but however, there are still a lot of unanswered questions. So for instance, the IBC gives a fresh start, a financial fresh start to the after successful resolution. So the Supreme Court had said that all the previous liabilities extinguish when given a financial fresh start. So therefore now insurance policies, there are 3 available online, though they are old. Insurance policies indicate or use the language that they are only going to reimburse or they are going to indemnify any liability. So therefore, if a liability is extinguished by insolvency, would the insurers still be then responsible after a fresh start? Because as we can see, I mean, a gas leak occurs. So if the company is insured, as long as the liability is faced by the company. That is, they face an environmental claim in the court. The insurer has to come in. They also might defend. They might step in. And but as soon as after a fresh start, the contingent liability is extinguished or capped, if you may, then can the insurer also claim that, well, the liability does not exist anymore after a fresh start, so we are not going to indemnify. So because again we are looking at insurance to be the answer, there needs to be some framework that occurs. So New South Wales in Australia has a very good example where they allow for insurers to be sued directly. That is, you don't need to engage in the process of making the insurer and the company both the party. You can directly sue the insurer. So a framework like that would be desirable, or perhaps even in a case the courts might answer the question. But again, because we are looking at insurance as an answer, there is some uncertainty involved which can be clarified. And again, even there are certain limitations for insurance as a solution. Specifically in the PLI Act, only accidents are covered. So let's say a company is consciously polluting a river, something like what happened in the tanneries case, where they were consciously letting wastewater in the river. So in those cases, insurance would not cover conscious acts, which would be criminal in nature. And we would say that rather they need better implementation of criminal law, because we can't account for criminal acts within insolvency to that extent. And the insurance scheme also has many caveats, saying that we are not going to pay government fines. So let's say if the government comes and fines the company for the act, the insurance company is not going to be liable for that. And again, the PLI was drafted in 1991, and the compensation figures have not been updated since. So the compensation figures are 25,000 in case of death and 12,000 for health liabilities. So again, outdated. And in that regard, there have been some efforts undertaken to revise these figures. There is a draft which has been circulated. But we need to understand that insolvency as a solution has greater limitations. That is, it does away with environmental claims completely. So yeah, again, insurance has one more limitation, that is, it imposes an additional cost on the business, that is, they have to pay a premium. So yeah, just concluding what we've seen, that environmental claims and liability get sidelined due to lower priority, and even in the new proposed mechanism where financial creditors would still be prioritized over operational creditors, government dues, this problem would still occur. And giving high priority might not be the most efficient solution, as it might open a backdoor or floodgate of claimants seeking higher priority, and insurance under the PLI Act, as is indicated, or similar legislation is better suited, although it imposes a cost on the business. And again, we need to realize that, well, at the end of the day, it's a mistake made by the company. That is, they have made a mistake, so therefore there is pollution. So a mistake resulting in pollution is never going to be an ideal scenario, and no ideal solution can exist. So we need to best accommodate insolvency, the goals insolvency tries to achieve, and the goal environmental policy tries to achieve, in harmoniously building a framework for both of them to be resolved. And insurance combined with insolvency provides an answer for that. Thank you.
Yeah.
One comment I'd like to make. While the act was being authored, I was part of the team. We were very conscious that it will have to be geography and sector agnostic. So the home buyer issue we could never think of. But the act will have to be agnostic of all these issues, because it has to be lean, mean and simple to interpret. A lot of things are happening, and in fact, this is a rejuggling of Act which was Companies Act of 1986, and things have almost remained same by for Companies Act having done. It is providing timeline, but I think it is high time that with regard to certain classes, let the Act forget being sector agnostic. Like the home buyer issues coming, you sign an MOU with the landowner, pay only 5%, start booking, take money from the home buyers, start doing work,
They pay major money and then you go to the banker and mortgage that land to the banker. And the home buyer is treated as unsecured. Though the regulator is working out. So I think there should be something which should not have a sector agnostic issue, because there are issues which are now emerging out. Second thing which the latest legislature is coming, that it has become a bottomless. The last few judgments like the Rainbow and all, they are making the act bottomless. That even after the approval of plan, there were cases like Ghanshyam Mishra, EBIX and all, I think they are being thrown out. It should not become a bottomless. See, recently some judgments have come which have made the law that claims can be admitted later, they need to be addressed by the SRA. SRA must pay tax dues, SRA must pay PF dues, like it has happened in the case of Jet. Jalans are being closed. I think there are certain things that it should not make it bottomless and not also make it sector agnostic. Thank you.
Thank you for that comment.
We'll have one more question.
Sir, if
There
I could.
are a couple questions online as well.
Sir, as far as the environmental claims are concerned, to prevent the cause of them, the environmental damages, NGT is there, or the PLI is there, okay. But you said that the environmental claims are sidelined in IBC. As far as my limited knowledge goes, I think IBC does not provide for environmental claims, and section 53 there is no mention. So do we propose to go for amendment and include environmental claims? And what is your take on that? Thank you.
Yes, so again, the IBC does not make any mention of environmental claimants. So we therefore explored what category would environmental claimants fall under. So as you said, section 53, there is a residual clause, any other debts and dues. So therefore, we analyze and we conclude that environmental claimants would fall under that head or category, and therefore they would be given accordingly the priority. That is a low priority, because as we saw in the waterfall mechanism, that yes, sixth priority, I mean any remaining debts and dues. So therefore environmental claimants would get lower priority in that regard, and therefore we explore, and therefore we conclude that they get sidelined because again they are not.
Environmental claims have to be more expressive in that clause then.
Well, I mean there could be many such claims as such. So as Sir rightly pointed out, the IBC was agnostic to all such issues, and I think even recollecting Professor Wig, who advocated for simpler laws rather than complex laws. So in that regard, I mean, if we try and look and include all such minute details into a law, it becomes more complex, which, well, I mean, is not desirable as well.
But to accord the desired importance to environmental claims or environmental laws, we need to be more expressive in this clause 6 where other debts and claims. If it is more elaborate, we will be able to cover better.
Maybe, yes.
Excuse me if I may. I think the online people are getting ignored there. So, with the permission of Chair, very quickly, as a comment on your paper and just quickly to answer some question that you're facing as a lawyer, probably I could step in here. See, if it's an environmental claim with the people holding decree from the court, there is no discussion and there's no debate about the claim. It falls in the category of decree holder. Now, any contingent claim becomes a challenge because insolvency about certainty. I do not feel a right that we should even debate about why unsecured should be given more priority. I think it will be completely defined insolvency jurisprudence. I recently saw the news in the Bloomberg also that we are now thinking of giving some priority to unsecured creditors. It just defies logic and insolvency jurisprudence. A quick comment on that: workers' compensation and claims are higher in ranking. It's not about human rights, it's about the contractual. You know, in law, the contractual claims have to be settled first before we go to the tortious claim, right? So the workers' compensation is given higher priority because of the contractual relationship with the company. I feel that you have a very good paper, but if you could delve into little jurisprudence side of it, how environmental claims are, is looked at, that would be very interesting. you have come to the right solution, which is PLI. And that I think is the best solution going forward. However, the problem is the quantum of compensation in PLI is a problem. Just like at FRDI, they were covering 5,000 rupees. I mean, 5,000 rupees is £5. In UK, we cover to 80,000 pounds to deposit holders. So I think the problem is about the amount of insurance and not about, and I think environmental claims any contingent environmental claims should not be considered in insolvency because that just, not only opens floodgate to litigation, it's not a certain claim, it's not a certain claim. And the claims have to be ascertained before it is disbursed to the claimant. So just a quick point on that.
Thank you for that observation. Just also further observing that, yes, we have observed that in our paper, and in our paper we do dwell deep into environmental and insolvency jurisprudence as well. And with regards to a fresh start, so all the contingent claims are wiped away after a fresh start. So therefore, if at all even under insurance they are to have to claim, then after a fresh start it becomes impossible. So therefore, we do say that there needs to be some acknowledgement of this and some way for the contingent claims to be determined even after a fresh start, where the insurer has to pay out those claims and not the successfully resolved company.
Yeah.
And yes. That would be more economic in nature. Yes.
On environmental, I would like to answer the question.
Sir, I think we
For large industries, I take 1 minute only. For large industries, there is an online monitoring by the Pollution Control Board. And in case you are affluent, your coal exhaust, your other discharge is higher, they close the factory and for restart they ask for bank guarantees. And Pollution Control Board holds large amount of bank guarantees. In fact, in the case of Bhushan, I think the guarantee was 80 crores. So that way, I don't know how far Pollution Control Board is active. They should take securities which can be enforced.
Okay, so now in the interest of time, we'll have to move on and we can take other discussions offline. Thank you, Sriram.
Recording stopped.
Everyone present here today. My name is it audible? Good morning, good afternoon to everyone present here today. My name is Dhruv Kohli and I, along with my batchmate Alingrita Patak, both of us are third year law students, and today we'll be presenting our paper on the topic, The Road Less Travelled, Advocating for Special Situation Funds as a Viable Solution in the Indian Distressed Debt Market.
So at the outset, I would like to lay down the objectives of our presentation. Firstly, we would start with explaining the working of ARCs in the wake of a new asset resolution mechanism, that is the IBC. Next, we would move on to have a comparative study with the introduction of SSFs. So how SSFs and ARCs are going to interact in the market and how SSFs could be a better alternative. Towards the end of the presentation, we would give an introduction to the Indian distressed asset market and provide some recommendations there. Now, when the IBC was introduced, its main goal was to foster credit throughout the nation. Its aim was to basically give a priority to resolution over liquidation. But the pandemic, a black swan event, has been detrimental to the IBC. It has been described as an event having more negative impact than the financial recession of 2007-2009. A number of economic, political and social upheavals have undoubtedly been brought by the pandemic. They have somehow pushed businesses on the verge of bankruptcy to turn to liquidation. Now this is where the importance of ARCs and SSFs comes in.
So firstly, to understand the importance of ARC or SSF, we need to first understand the mechanism of asset reconstruction that is followed in India. As we all know, banks form an essential part of the Indian economic system as they give us the necessary capital to kickstart any form of industrial operation. The problem arises when there is non-repayment of the credit that is supplied by the bank to any of the debtors. These non-repaid loans, as we all know, are called as non-performing assets. Now, non-performing assets have been a vicious problem for the Indian economy, and this is a fact that we all know. Just for some statistics, the non-performing assets in India have ranged from 15.7% in 1998 to 11.5% in 2018. Even recently in 2021, when the Honorable Minister for State of Finance declared that non-performing assets have reduced down from 1036,000 crores to 834,000 crores, he did not take into account the COVID period, that is from 2020 March to 2021 March, which if we take into account again shows us that non-performing assets have not reduced in India. To deal with the issue of non-performing assets, successive governments have tried out different forms of mechanism. One of the first mechanisms that were tried in the Indian economy was that of debt recovery tribunals. So DRTs were basically established to deal with amounts of defaults wherein the claim amount was up to rupees 10 lakhs. And DRTs were also authorized to establish what are called as lok adalats to deal with claim amounts wherein the amount was up to rupees 20 lakhs. Initially, DRTs had achieved success wherein in the period for 2003-04, statistics tell us that DRTs were able to ensure a successful claim of up to 79% of the claim amount. However, with their overstretched capacity and the lack of infrastructure forced the downfall of DRTs, which is evident from the available statistics that the total amount of claim that DRTs were able to successfully get reduced down from 79% to 4.1%. Post DRTs, another new form of mechanism was introduced in the Indian distressed debt market. This was called as asset reconstruction company. ARCs were basically introduced in the market because of the downfall of DRTs, and the first ARC, as we all know, was ARCIL. While the number of ARCs in India today stands at 28, so is not the case with the effectiveness. As can be seen from this graphical representation, for the period of 2013 and 14, it is the only period wherein the asset under management for an ARC has been increased. Post the period of 2013-14, we can see a drastic downfall in the functioning of ARCs. This can be attributed to several reasons, the foremost of which is excessive regulatory interference. As we all heard in the keynote address in the yesterday's session, excessive regulatory interference might sound as a good idea in theory, but practically it has not been the case. In 2015, the Reserve Bank of India introduced a host of changes for the functioning of asset reconstruction companies in India, post which, as the graph shows us, the asset under management for ARCs has significantly gone down. Other reasons for the lack of functioning of ARCs include inadequate legal procedure, price dispute between the banks and the NBFCs, lack of funds with ARCs, and most importantly, banks and NBFCs not selling the NPS at the correct time to the ARCs.
Now, as we all know, the year 2016 saw major change in the Indian distressed asset market. The IBC was a code that aimed at consolidating all existing laws and practices on resolution of stressed assets into one. Within the resolution process of IBC, one of the most important entities is that of a resolution applicant. The resolution applicant is the white knight who comes to the aid of a corporate entity undergoing an insolvency process. It has been defined under section 5, subsection 25 of the IBC as any person who submits a resolution plan to the resolution professional. As stated earlier, the primary purpose for which IBC was enacted was to bring a change in the asset management mechanism of India, of which ARC since 2002 had been an important part. Now, the IBC regime allowed not only individuals but also institutions to be a part of the asset management system. That somewhere meant that ARCs could also act as resolution applicants. In practice, that was the case. In the matter of Maxim Infrastructure and Real Estate Private Limited, Apparent Iron and Steel Private Limited, and Palm Lagoon Backwater Resorts Private Limited, ARCs have acted as resolution applicants. This conundrum with regard to whether or not ARCs can act as applicants was finally resolved by RBI as per a report dated 11th October 2022. where RBI allowed ARCs to be resolution applicants. Now that we have covered the very basics, let's move on to analyzing AIFs that SSS has been introduced. According to the amendment regulations of SEBI, special situation funds have been envisaged to be established under the subcategory of Category 1 Alternative Investment Funds. Now, let's move on to a comparative study. When compared to SSFs, ARCs are limited to using no more than 25% of the funds they raise for reconstruction of the financial assets that they have required. Now, no such restriction is on SSFs. Moreover, ARCs are currently limited to buying stressed assets that have been default for more than 60 days or that are considered non-performing. In this regard, again, no such restriction are applicable for SSFs. Now, allowing SSFs to act as resolution applicants under IBC, SEBI has made it possible for SSFs to acquire both debt and securities, including shares of stressed companies going through an IBC CIRP process. Such provisions permit the SSFs to provide a thorough exit to lenders and control the revival of a stressed company. But currently, the problem is that SSFs lack the asset reconstruction authority and unique benefits provided by securities laws to ARCs. So we currently advocate that if SSFs are treated at par with ARCs and provided some of these benefits, they could be a more viable solution in the distressed asset market. A review of such legal restrictions should take place and an attempt should be made to provide SSFs equal benefits as given to other investors.
Taking over from where my colleague just left, while we have advocated for promoting SSFs and creating a conducive environment, we have to keep in mind that SSFs alone cannot be the answer. We need to even solve the basics of our Indian insolvency regime. The first basic that we all should be keeping in mind is to reduce the time issue. We all know, we all have studied, even in the parliament the report has been stated that the average time taken to complete a insolvency proceeding anywhere ranges between 500 to 560 days, whereas statutorily it has been recommended to complete in 330 days. Moreover, the delay is not only on the part of completing the insolvency proceeding. The delay is also in admission of the insolvency application. The statute prescribes a period of 14 days to either admit or reject an application to initiate insolvency proceedings. However, yet the average time taken as per a report by IBBR states it's 650 days. There are practical reasons for delay in admission or rejection of an insolvency application, and there are certain judicial decisions which have also contributed to the same. For instance, there has been a judgment of the Supreme Court in Surendra Trading Company versus Jagilal Kamlapat, wherein the court has stated that the 14-day period that has been prescribed by the statute is merely directory in nature. The statement by the court that it is directory in nature itself dilutes the importance of a 14-day application. What happens when a directory inference is given to such a time period is that the value of the corporate data anywhere decreases, which forces all the creditors to take massive haircuts on their loans. Additionally, the Indian insolvency regime works on the principle of a creditor in control model, wherein we go by the assumption that once debt kicks in, it is a creditor who takes the control. This has also been the foremost basis that has been stated in the Bankruptcy Law Reform Committee report, which formed the basis for the IBC. However, what we also propose is that perhaps we should also take a look at this approach wherein we are overtly focusing only on the creditor, and we ask the debtors to completely go away from the insolvency proceeding. As the American example tells us, in American insolvency proceedings, there is an element of debtor being present within the proceedings, and he is not completely ousted. Lastly, while there are a lot of points that we have recommended in our paper, one of the key points which we need to focus is on regulatory interference. I don't know how many of the members here are aware, but a few months back, Securities Board of India, Securities and Exchange Board of India, they proposed a framework wherein they recommend that the shareholders of the defunct corporate debtor should be given a seat at the COC, and the resolution applicant should be asked to provide them with the shares of the new entity which is formed post the insolvency proceedings. Now, theoretically, while this might sound a good plan, practically we need to see how much is it feasible, because a lot of these SSFs or ARCs comprise of foreign investors who would want to operate independently once they acquire the defunct entity post the insolvency proceedings.
Now, the amendment regulations are surely an innovative step by SEBI and will aid in luring investment towards special situation assets, but clarification on certain points is still required, and we believe that certain steps such as revising the taxing regime and considering the option of giving SSFs full control over the entity of which they acquire the debt should be a useful step in the market. Now, AIFs can occasionally be used to fund ARCs as well. At the current moment, the idea that is proposed is the establishment of an ARC to deal with NPA resolution and an AIF to deal with funding for asset accumulation. Now, what SSF does is, it's a single entity that combines the benefit of both. That is, of an ARC, that is stressed asset resolution, and an AIF, that is pooled funding. Hence, SSFs for sure, according to us, can be a viable alternative to ARCs with respect to asset reconstruction if treated at par with the latter.
Thank you, Alamrita. Thank you.
Thank you.
Questions?
I have three questions. First is that you said that Jubilal Kamlapat case, the court has said it is directional, timelines are directional, and by making it directional, they have diluted it. In this case, my opinion is that to meet the ends of justice, you want to compromise on the ends of justice. It will lead to the miscarriage of justice if we are so time bound and court is not able to deliver in 14 days due to so many government holidays and all that. So in one way it is sort of a disagreement you have with the court judgment. In this some elaboration. Second is that suspended board of directors are invited for participation in the COC. It is ARC is holding everything in control, but the opinion of suspended board of directors who have been there for so many years or so many days, they have all the ins and outs of the company. So we can take inputs from them for further managing and taking further the company. So in this regard, what will you say? And you want to put ARC and SSF at par as parallel organization? That is what my query is. Thank you.
Thank you, sir. Firstly, coming to the first question that you raised with regard to the judgment, when the code was enacted, there was a reason why the 14-day period was prescribed under the statute. Insolvency code is an economic statute. Therefore, if the legislators have given the 14-day period, I'm pretty much sure that they have taken the ends of justice into account. When the court says that the 14-day period is merely directory in nature and it should be followed, but if it is extended, it won't be a harm. What the court did not, perhaps in my opinion, did not realize is that there is an economic value that is attached to a corporate debtor. When a company is at the gates of the tribunal and is asking to undergo an insolvency proceeding, it is asking to be saved. The more delay that we take in either admitting the application or rejecting the application, the more harm we are causing to the entity. Let's say an entity comes with us when its value is 100 and if 650 days are taken to just reject the application, the value of that entity is now nothing. And if we are admitting it, then the creditors won't have anything to get. That is the reason why we need to take 95% haircut. In the Videocon case, as we all know, the creditors took a haircut of 96%. and the operation creditors, as we all know, don't receive anything. Recently, Adani Group purchased a building association through a judgment in Mumbai, wherein it took a haircut of 98%. The problem is these haircuts are a direct result of the time delay that is present in the present system. The ends of justice are not being met when we see such delays. The ends of justice would be perhaps met if, let's say, the delay is only 20 days or 25 days. There's still a chance to save the corporate entity. But by not following the prescribed time limit, we are not saving or we are not doing justice to the corporate entity. Instead, we are doing more harm to them.
But they may be able to misuse the given time limit. They will try to delay and then somehow they will say, okay, now it is time barred. That is also the issue.
Perhaps that is why all the stakeholders need to look into the time issue. The time issue is the most important hindrance that is present in the current insolvency regime. We repeatedly see reports of blogs being written and opinions being written on how time needs to be managed under the Indian insolvency regime. Recently we see, if I am not mistaken, creditors of Reliance, one of the subsidiaries of Reliance which is undergoing perhaps the insolvency proceedings, they have delayed the proceedings for almost a year. This is how they are misusing. But if courts,
they are misusing this.
Because of the fact that courts say that it is not direct, it is not mandatory to follow these time limits. When the courts themselves are not bound to follow these time limits, when the courts have the liberty to extend the time limits, it's a backdoor entry for the creditors or the debtors to misuse it.
Well, friend, here.
Final question.
Yes, one question.
So the question of ARCs and SSFs being treated at par. So now SSFs have existed in the global scene for long. In India, AIFs have existed. SSFs are a new entry in the market. They came in 2022. Now the question as to how their introduction in the Indian distressed asset market will play out is of importance here. So we are basically suggesting some of the steps that could be taken to make this introduction more effective, as to bring innovation in the market and a more effective resolution as to the stressed assets. So SSFs have been introduced. Now, to what legislation should they be subjected to? What restrictions should they be subjected to in order to make their functioning most optimal is what we are suggesting here. So we are saying that since ARCs have been, there's a question, clarification is required on SSF's ability to acquire loans as a part of the resolution plan. They have been permitted to as a resolution applicant, but there are certain loopholes, many loopholes that do exist, if I must so say. So we're just suggesting that we should look into the RBI master directions which exist for ARCs. We should look into what direction exists for AIFs, and then we should work on convergence of both and apply them to SSFs in order for the optimal functioning. That is what we aim to achieve here.
Well, you were referring about SEBI, giving some kind of a ruling where shareholders should be given a presentation in the COC meet. But I am of the view that the board of directors representative, as rightly told by my friend, are already sitting in the COC meet as an invitee. Their views are always considered by the resolution professional. So don't you think that that is been addressed by the IBC long before SEBI has actually come out with this proposition? Number one. Number two, somehow during the course of your presentation, you are taking the side of SSF. I don't know why. Why? See, SSF is a resolution applicant. You are talking about that SSF has no funding support and they need a lot of funding support. Whoever wants to be the resolution applicant should take care of their funding aspect. There is nobody else to come forward to give them funding support. So how do you justify this?
So firstly, to answer your second question, that's about funding. So basically we wanted to say that currently there exist 28 ARCs in India, and the problem that exists with funding is with ARCs. So according to certain estimates, the ARCs need 300 crores with them to invest into stressed assets, and that is a problem that they face. Now that is what we are saying, that the introduction of SSFs, they will lure foreign investment into India if they are being authorized as permitted transferees under the RBI master directions, and basically that is the problem of funding would be solved through SSS. That is what we are trying to say here.
With regards to your first question, sir, the SEBI framework which I mentioned in my presentation, it refers to giving protection to minority shareholders or the non-promoter public shareholders. So if you read the report, it's dated 10th November 2022. It was introduced in wake of certain public listed companies undergoing CIRP and the public shareholding being reduced to absolutely zero, wherein the public shareholders were given next to nothing. A case was also filed before the Supreme Court in the case of JP Kensington Boulevard, wherein the Supreme Court very clearly stated that the minority shareholders per se do not have the right to get a seat at the COC, and whatever the resolution applicant is giving to them is more than enough for them. What I wanted to say through this is that such excessive regulatory interferences in the functioning of SSFs can prove to be a harm. We have seen with ARCs up to the period of 2014, if I may show you. If you can see this graph here, up to the period of 2014 wherein the regulatory interference was minimal, ARCs were able to function quite nicely. However, in 2015 when RBI introduced a host of changes in their functioning, the asset under management of ARCs went down drastically. Even RBI in one of its bulletins did agree to the fact that it was excessive regulatory interference which caused to the downfall of the functioning of ARCs. So what we are trying to say here is that by introducing SSFs, you cannot simply imagine that the stress asset situation would be solved. You need to even take steps in that direction, one of the first being less regulatory interference.
Okay, we'll go stop it there, let's go. Thank you, Lankita. So we'll move to the next presenter. We have Mohammad Ali Khadim Hussain Momi from Peer Dharmat South Gujarat University of Surat, presenting on impact of COVID-19 on corporate distress and bankruptcy of retailing companies.
I don't think that I could give my introduction to because the time bound is going to 1:08 and it is now. So moving towards the paper, myself Mohammad Ali Khadim Hussain Momi, a research scholar at Faculty of Commerce at Peer Dharmat South Gujarat University Surat. The topic is the impact of COVID-19 on corporate distress and bankruptcy of retailing companies listed on Bombay Stock Exchange. Okay, now as we have moving towards now a quantitative analysis. In this paper we have covered a quantitative analysis. After the global financial crisis of 2009, the financial distress has been an emerging concept, and COVID-19 makes the challenges for the company to operate profitability. As a result, company financial condition is disturbed. And now the definition of financial distress as by the Salim in his research paper of 2021, it has stated that with the increase in the liability and the decrease in the assets is caused the financial distress to the company. Another, the financial distress is the final stage of the liquidity crisis for that company. It is stated by the Turan in 2021. Now why we have selected this topic? So according to the research of Construct 2021, it has stated that for causing of the financial distress, the one of the major factor is natural disaster. So the COVID-19 is also a natural disaster, so it is a cause for the financial distress. So the financial distress and bankruptcy are virtual issues in the business and national economy during the crisis, and as the low and middle income countries such as India, we are hurt by the financial distress of the company. Retail companies have suffered a lot during a pandemic because of the lockdown has been announced by the policymakers, so they have suffered a lot. The financial distress accounting models were used to measure the financial distress. Various models such as Altman Z score, Danish M score, Springett S score, Olson O score, Zivakati X square, Gover G score and Protesix F score were used to measure the financial distress of the companies. Investors have lost their wealth by not making a proper investment decision in the companies. Okay, the another point is the investors are losing their wealth. Why? Because they are not making proper investment decision. Business have lost money because of their investment in financial distress. Okay, business have lost wealth. Why? Because they have made an investment in that business which are financially distressed. Now contribution of our this research paper will study add to the literature for the corporate financial distress and bankruptcy. The study contributes to the predicting the accounting model which adopt various accounting techniques. And lastly, the paper will help for the nation policymakers and portfolio managers to predict the financial distress for the corporate liability of the company sectors and other things. Now, these are the literature review. I will go through this. I have covered only 6 research papers which are published in the reputed journals. First is the financial distress in hospitality industry. As retail industry, there is also a hospitality industry during the COVID-19. It has stated that 25% firms are predicted to be fail by logic model, and they are stressed when the solvency and liquidity problems are considered as a COVID-19 pandemic. Okay, so the research gap from the literature review, we have found that there are few studies available on the prediction of the financial soundness of the Indian service industry. Second, however, Indian retailing industry remain untouched. Many of the author has done the measuring the financial distress of other service industries, but the industry of retail industry is untouched. So we have gone for the research for the retailing industry. Therefore, the study attempt to bridge a mandatory research gap by analyzing the financial soundness of retailing companies in Indian retailing sector. The main objective of our research, the study goal is to assess the financial distress of Indian retailing companies listed on Bombay Stock Exchange in aftermath of COVID-19 pandemic. Now the methodology, so the retailing sector of the Indian economy based on Bombay Stock Exchange. Total 18 companies are listed under the retailing sector. Okay, the time period for the data is from the 5 years for 2018 to 2022. For data collection we have used Proves IQ. These are the variables which are used for calculating various models. Okay, there are model Altman Z score, Bennis M score. They use variables. There are financial ratios. So these are the variables are used for calculating the financial ratios for the below accounting models, and the statistical tools are used. Now, Sparrow will test executed as we are working on the data secondary, and we must work for the normality of the data. We must have to check the normality that the data are normally distributed or not. So our assumption has been proved here, and by running the Durbin-Watson test, we have determined there is no autocorrelation among the data, and multi-collinearity test has been also calculated, so it is also been fulfilled the assumption. And lastly, we have Homrush and Lamnos test has been covered. Now here the comparison results of the model. Total 17 companies, total 18 companies are listed on Bombay Stock Exchange in the retailing sector, but one company it has registered on 2019, so we cannot consider that because we have taken the time duration of the 5 years, so we have excluded that company. And the 17 companies, the data you can see on the various 7 models. See, financially distressed, Altman Z score shows that from 17 company, 8 company are financially distressed. Then Bennis M score shows that 12 companies are non-distressed, only 4 companies are. So now what our research is? Our research is we are having the 7 models for predicting the financial distress, but which model is more accurate to measure the financial distress? Okay, so here the level of accuracy and level of error has also calculated, and you can see that stringent S score has the more highest level of accuracy for calculating the financial distress of the companies. Now the result of the study states that both Altman Z scores and Bennis M scores are appropriate for measuring the financial distress of retailing companies. The result of the study supports the finding of this author who stated that Altman Z score and stringent S score both give accurate results relating to the bankruptcy of retailing company registered on International Stock Exchange. Now the study of premise stated that Altman-Springer geometry model give the most accurate result for predicting the financial distress, while Grover G score model have insignificant accuracy for measuring the financial distress of retailing company. Lastly, towards to the conclusion, as I have shown the table of all the company, beside on the result of that Altman score predict that 8 out of 17 companies are financially distressed. Okay, Bianis M score has predict 4, and lastly the name of the companies which are being measured as a financially distressed company according to our research. Thank you so much. Yes, any question?
Into account by these models.
Yes.
You say Benish model or a
Okay.
Springate model. So I think we need to think on modifying the model according to the Indian conditions.
Okay, ma'am. Actually,
there can be a future scope of research. For the capacity of time, I'm just putting this question.
Yes, ma'am. Actually, for predicting the just one answer for predicting the bankruptcy and distress of the company, there are two methods. One is accounting measurement model, which we have followed the 7 accounting models, and other that is AI method. But the AI method, but we cannot cover AI method because it will overlap the conclusion, or it will overlap the answer, the data analysis which comes from the accounting model. It will overlap the AI will overlap that answer. Yeah, sure. We will work on that, and sure. We will work on that, and we will create a new model. As per your suggestion, we will work on that, and we will create a new model. Yes, sir. Okay. Any other comments? Okay. Thank you so much for listening.
Thank you very much for your presentation.
Good morning, everyone. I am Khyati Sharma, a fourth year BBA LLB honors student from Symbiosis Law School, Pune. Today, I will be presenting on my paper titled Gaps in Information Retrieval Mandate by IUs for Various Stakeholders in Insolvency and Bankruptcy Regime. Now, you must be thinking that what am I talking about when I talk about gaps in the information retrieval mandate by IUs? Because we already know that in 2022 the amendment came and it made it compulsory for operational as well as financial creditors to submit record of default before filing for CIRP applications. Now, when I talk about gaps in information retrieval mandate, I don't only talk about the mandate for providing record of default information. See, I'm young, I'm 22, I'm allowed to dream and have a utopian world. And in my utopian world, IUs don't only work as platforms for collation, dissemination and collection of information, but also as platforms for risk averment for creditors in our Indian society, for the credit ecosystem of the Indian society. And how do I exactly propose that? Is the question here, is what I have discussed in my paper. Now, we know that NESL is great. It's the only information utility that India has right now. And yes, it informs all the creditors out there whenever there's a default in terms of one creditor. So you might think that, okay, risk averment system is already there. But in my utopian world, like the stringentness, the loopholes are not there. And what are those loopholes that I'm talking about? We all must know about a notification that was released by RBI in 2017. I would like to move to that slide. Not this one, sorry. Yeah, circular number RBI 2017-18-110. This was released on December 19, 2017. Now, this particular circular released by RBI made it compulsory or asked, not exactly mandatory, I will tell you how, but it asked all the financial institutes to provide information to the information utilities in compliance with section 215 of IBC. Now, section 215 has two subsections, subsection 2 and subsection 3. Subsection 2 is regarding financial creditors, and the words that are used are: a financial creditor shall submit then the information that is being talked about, that is required to be submitted to the IUs, while on the other hand, the words that are used in subsection 3 is not shall but may for operational creditors. Now, when this circular number RBI 2017-18-110 talks about the mandate, not exactly the mandate, but it talks about, like, it asks the financial institutes of the country to start providing financial information regarding loans to NESL. It does not have a deadline for doing so. I was reading newspaper in October 2022, and I read that American Express informed all of its users that from November 2022, they will start providing information to NESL in compliance with the said circular that was released long back ago in 2017. Now, this circular not having a deadline is a big loophole, because if we want to create the kind of risk averment environment that I think about, so that creditors can see what kind of risk they will be entering while providing loans, because there are a lot of bad debts and NPAs in the credit ecosystem right now, and we would like to not have them. So, in order to ensure that, we must have a risk averment system in place, and IUs can do that job, is what I have proposed. Now, for that, we would want all kinds of financial information regarding debts and defaults, but without a deadline mentioned in this circular number. If tomorrow I want to open up a bank, or suppose any credit card company, I might not comply with the same. And there are certain concerns that the stakeholders have, and they are very genuine. For example, the data security concerns. Now, these data security concerns, they have to be tackled. And I have proposed in my research paper, sorry, this was a last moment presentation. Yeah, I have proposed the use of fintech solutions, blockchain technologies, as well as tokenization. I think in in the beginning of the 2021, I guess long ago since then, few years ago, RBI started with this process of tokenization for banks. It has started with, bringing tokenization for making sure that whatever information is being shared regarding the accounts of people in the online payment system is protected with the help of online fungible tokens. I think something like that, in lines of that, when we share information within the IUs to registered users, we can use fintech solutions like tokenization and other blockchain technology solutions to ensure that the data that we have is secured enough. This will ease out the fears and concerns of the various stakeholders in providing information to the IUs in the first place. Now, definitely, there are other concerns when it comes to creating that kind of risk averment environment. We know that the status of operational creditors is not the same as the very financial creditors in our IBC regime. Now, I propose that even operational creditors must be mandated to provide information regarding operational debts to IUs. And why do I propose so? Now, this idea came to me once while I was just taking a walk, and I'm just a puny little law student. I'm very sure that a giant corporate magnate can come up with this idea to exploit the loophole. I will tell you what. Suppose I have a corporation and I'm in a very, very bad financial health right now. I'm about to default. Now, I have financial creditors and I have operational creditors, and I know that if I default on my financial creditors, NESL will inform other financial creditors, so I won't be able to access the loans that I want to, go on as going concern, or whatever you call it. I'm really sorry for that. So, yeah. So what I would do is, I would not go ahead and pay my operational creditors and keep on paying my financial creditors. Now, this will create zombie companies, and we all know that zombie companies are not at all good for the economy. I might just think that okay, I will be in a good financial position from 2 to 3 months from now, but I'm not addressing the basic problems like bad management techniques or strategies. But I'm just taking more and more loan, and I'm not defaulting on my financial creditors, but I'm defaulting on my operational creditors. It has been 1 year, and I'm just on the brink of defaulting financial creditors now because I don't have an option, and financial creditors had no idea about the same, right? I'm a private company. I do not publish my books of accounts. No one has any idea about what's going on. So that's why I think that it's very, very important that even operational creditors must be mandated to provide information regarding any accrued bills or any defaults that are happening, so that we can make a proper risk averment system for Indian credit ecosystem. Now, going forward, one other thing that I would like to talk about is retail investors in our credit ecosystem. Now, we must understand that it's not just the big financial institutes that are a way of raising capital in our Indian market. Loan stocks, debentures, convertible debentures and convertible shares, etc. are also a way through which giant corporates or even small companies, they raise capital. Now, a lot of retail investors are not people like you and me. I'm on the lowest level of the food chain, but some people are not privileged enough to even have a formal education. And still they want to invest in the retail market, in the capital market, and they do that. And it's a very important way of raising capital for a lot of corporates out there. I propose that this all financial information regarding debts and defaults is difficult for a common layman to understand and analyze, and to understand that what is exactly happening, whether I should buy these debentures or not. So it's very important that, if we are creating that risk averment ecosystem, we should be very inclusive, and pro bono industry experts might provide their analysis in layman language for people on the websites of information utilities or wherever they can, on IBBI or in the websites of information utilities, so that people out there, retail investors, can understand what is going on in the economy and they feel inclusive as well. Now, last thing that my paper talks about is the difference between operational creditors and financial creditors in our Indian insolvency regime. So we see that operational creditors are not at par with financial creditors, and in various different decisions such as the SR Steel or Swiss Ribbons, again and again, the court has undermined the position of operational creditors, not letting them sit at par with financial creditors or have the same rights. I was doing an internship in Supreme Court in January, just a month ago, and my senior had a friend. He was working in the area of insolvency and bankruptcy, and that advocate had flew in from Mumbai. He had several offices in Delhi, Mumbai, Chandigarh, and he came there. And we all were the interns and the seniors were in the canteen having a nice lunch, wherein we talked about the practical aspects of what is going on. And that respected advocate made a comment. He said, "You young people, you know what? IBC is a bogus law." And I was shocked. I was like, I just read the subject in previous semester. Is this something? What? Yeah. I haven't been changing slides actually. Yeah. It was a last moment thing, so. So he said IBC is a bogus law, and I was very much into the subject because I just read it in the last semester, and I was really enthralled by it. But when he made that comment, I was shocked. So I asked, "Why, sir? Why do you think IBC is a bogus law?" He said, "Kathy, do you know that in the initial years of my career, I used to work as a labor lawyer, like labor in the field of labor law. And I've worked with the management, I've worked with the labor unions as well. And now I'm working in the field of IBC, and what I have seen is, in most of the cases, employees who haven't been given their salary since months and months, they do not get anything. And I was not able to answer this question because, yes, I know that employees are considered operational creditors. And operational creditors are not given rights in the committee of creditors, because of which they most of the time, get left out. We're a common law country, and it makes complete sense to compare ourselves with another common law country, which is UK. UK gives every creditor seat as well as voting right on the committee of creditors in proportion of their debts. In India, it has to be, operational debt has to be 10% of the aggregate debt for operational creditors to have even a representative on the committee of creditors. And that representative over there cannot even have voting rights. Now, when we compare it with UK, the situation in UK seems a little bit more fair. And on the other hand, the major decisions relating to CIRP process over there are taken by IP, which is appointed by the Court of Law. Now, this IP that is appointed by the Court of Law is a neutral third party. Herein, all the major decisions are being taken by the Committee of Creditors, and at the same time, a major chunk, that is operational creditors, are not given any voting rights. So what I have proposed in this paper is that either we give them the voting rights, or we let a neutral party like an IP take major decisions in the CIRP process. So I would like to conclude my my paper in a few points. So what I have proposed in the entire paper is, first of all, creation of a risk averment system, for which we would need three things. First of all, we need to put a deadline to the circular dated 19 December 2017 RBI / 2017-18-110. Second thing, we must also make it mandatory for the operational creditors to provide their operational debt information to the information utilities. Third thing, there must be a system of providing analysis of all this complicated information to retail investors, who are also a big part of the credit ecosystem, purchasing the loan stocks and debentures of these companies. And then a very important thing is to have fintech solutions for providing data security, so that we can have a secured platform where every stakeholder feels it safe enough to provide information, or the information of, suppose their credit card customers, to the information utilities like American Express just started. And in the end, operational creditors must be brought at par with financial creditors by either giving them proper voting rights, or changing the system a little and asking a third party to take major decisions in the CIRP process. Thank you very much.
So this is related to your topic on information utility. Ministry of Corporate Affairs issued a letter, a notice dated 18 January 23, wherein they have invited comments from the various stakeholders or public in general regarding the amendment. And the amendment, proposed amendment, which says that, and this addresses the point wherein delays are happening in admission of the claim. The amendment which is proposed says that default information available on the information utility should only be considered by adjudicating authority. Basically, NCLT should look into this. If default is there, they should immediately admit the admission. Yes. You can consider this point in your report, your research, and you can provide your comments. So this is one suggestion I am putting.
So sir, this is regarding what is being proposed in the amendment is that the adjudicating authority should not waste its time on debt adjudication, that you're saying.
Yeah, that's true.
Yeah, so I think that this is this is a good amendment, and I think the 2022 amendment that I talked about, it made record of default to be provided while initiating CIRP process mandatory. Now this record of default is nothing but the information regarding the amount of debt that has been already verified by the information utilities. So when it is already verified information, adjudicating authority won't have to waste their time on debt adjudication, which was a problem like years ago in other insolvency regimes that we have had in the past.
Yeah. So there were pros and pros both there. And the committee was invited. Last date was 7th of February. Also, in your second observation about giving importance to operation creditors, there are checks and mechanism currently also in place in IBC, which says that operation creditor needs to be paid on priority to COC, to the financial creditors. So basically, the operation creditors are not sitting in COC meeting where decisions are held, but it's on the mandate on the COC members to consider that those are paid in priority. And also there is independent body, the adjudicating authority NCLT, who approves the plan. It's not the COC who votes approves the plan. Of course, there are always chances to scope for improvement, but these are the current position, is what I wanted to mention. Thank you.
See, you made one you shared one interesting experience. What is your call on IBC code? Number one. Number two, in your presentation, you were viewing that employees should be brought on par with operational creditor. Is my understanding correct? Just clarify.
Sir, employees are considered operational creditors under IBC is what is in my knowledge currently, like as much what I've read in the classes. And what my take on IBC is that I don't think it's a bogus law. I think it's a very good law. I think because that advocate that I was talking to had been involved in labor law for long and he had some emotional attachment with the employees. That's why they would have made that comment. But I think it's a good law, and new evolutions are happening every year, and some very interesting amendments have been brought, like for example the one regarding record of default, which would not let the adjudicating authority waste its time in debt adjudication, etc. So I think it's an evolving law, and I think along with proper changes over due time, we would be able to reach a point, where we take care of all the stakeholders. That's what we are trying to achieve.
Just a submission for due inclusion in your study. You can make a HR policy as a part of IBC code. This can be one of, because you touched upon employees' plights. That is why. Just you make a study, and then if it is suitable, you can include it in your report. That's all.
Sure, sir, I will look into it.
I think labor laws have got a due place in the IBC. If you go to the labor law section, this IBC sections and regulations, they have been sufficiently covered. Rather, to highlight section 53. 2, 3 already take care of workmen and employees. One. Second, 20 largest operational creditors are always to be part of COC as far as I think. Then next is the role of blockchain technology. We are not able to clear how it will contribute to our IBC. Can you elaborate? And then you retail investor, you are telling prospectus of companies is issues in which everything is given. And leave aside the retail investor, nobody reads, barring a few. So that part that people should be given more information. What this prospectus, this big is there, nobody is able to read. What more can be given?
Okay, so starting from your first question, that was regarding section 53. I'm not aware of that currently. Moving on to your next question, can you please repeat the same?
53 is talking about employees and this year, and elections are also there. Second question is 20 largest operational.
Achha, so I think as much as I have read that it is in absence of financial creditors that the 18 largest operational creditors make the committee of creditors, and if financial creditors are present on the scene, then in case the operational debt is more than 10% of the aggregate debt, then they are given a representative that will sit with the committee of creditors. And so the next question was regarding Blockchain technology. I think the way that tokenization was implemented by RBI for information in the payment ecosystem. I think as a credit card company like American Express, which is also a financial institute, and if they will be providing information to the information utilities, they would want the data of their customers to be safeguarded, or else they can lose. If that data is compromised, they can lose their name in the market and their value in the market. So for safeguarding the rights of the financial institutes who would feel more comfortable to comply with the guidelines if everything is secured and safe, I think tokenization and other such blockchain technologies which can be more researched upon should be brought forth.
How is it blockchain technology helping in our IBC?
So it is securing the information that is there. The information won't be compromised. And your fourth question was regarding retail investors, and everything is mentioned in the prospectus of the company. I would like to say that the information regarding the defaults of a particular giant corporate magnate might not be that much highlighted in its prospectus when it wants to raise money through debentures or loan stocks. And apart from that, I also said that in my risk averment ecosystem, I would want the information regarding dues of operational creditors must also be brought onto the platform. So the analysis of all that information must be provided to the public is what I have proposed.
Kolhapur, he is a distinguished professor of accounting in ISB, and he needs no much introduction. So he has extremely good research. He's editorial board on several journals, and we have Professor Devjyoti. He is also extremely well researched. His research interest range from Bitcoin to commodity markets. So and we are happy to honor both the professors as session chairs. So we have 5 papers. So I would request, before proceeding, to some couple of words from our session chairs.
Thanks, Arnav, for that introduction. So, in this session, we have, first of all, thanks to all the attendees and the presenters for joining us. Thanks for your valuable time. So, in this session, we are going to have 5 papers, and we'll try to, keep it to the time. So, we have 20 minutes per paper, followed by 5 minutes of questions and answers. So, before we get started, I would request Professor Sanjay Kalapur to share a couple of words of wisdom. Then we can get started.
Thank you. Thanks to IPBI and IIMB for inviting me to moderate this session. We have 5 papers on a variety of topics related to bankruptcy. So thank you for coming, and let us all give a big hand to the paper presenters for what is sure to be an enlightening session.
Thank you, Professor. So we'll get started from here.
First paper by Professor Swetcha from Great Lakes, and he will be presenting on earnings management, stress and auditor change, 3 steps towards bankruptcy.
Can we see the presentation there? Good afternoon, everyone. Thank you IBPI and IIM Bangalore for giving us this opportunity to present our work. This is a preliminary study, very basic analysis, but the idea interested us, so we got started working with my co-authors Rupesh and Sumit. So we know what is bankruptcy. It is a situation where firms' cash flows are not enough to meet the debt obligations. But as much as it sounds like a negative word, it is an essential feature for a frictionless economy. Any quick resolution of claims of the creditors will help smoothing the functioning of the firm, either or will go for a liquidation. Peter Lynch in 2007 says that it moves the
recording in progress.
So Peter Lynch in 2007 basically says that bankruptcy and the resolution process usually moves the capital from unproductive sources to the productive sources, which is a good thing. And we know, as the conference is about Insolvency and Bankruptcy Code, introduction of it. Before introduction of IBC, pre-IBC, the recovery rate was only around 15%. Post-IBC, the important part of IBC is the importance of or the dominance of the creditors' rights. Once IBC has been introduced, around 14,000 applications were filed within 27 months. We all know all of this, but what basically interested us is what is happening to the bankruptcy resolution process, what is happening whether the firms are going for liquidation or reorganization, and can we predict whether the bank is going to be bankrupt, and after bankrupt, what is going to happen to this kind of firm based on the characteristics of the firm itself or what they are reporting. As observed in 2020 and 21, it took around 468 days to accept the insolvency application. And in financial year 21-22, it took around 650 days, which has increased. But the stipulated time was only 14 days, so we see that there is a huge delay and a significant delay. This delay results in the depletion of the value of the firm or anything that can be salvaged at a later date. So the objective is to trying to reduce the delay. And in the last conference, IBPA conference, first conference at Ahmedabad, this was a quote made by the Deputy Governor of RBI. I'm pointing out to this highlighted terms, which says that the point at which the counterparty has become insolvent cannot be pinpointed correctly. And the risk management practices of the lenders have to be sophisticated enough to capture these changes in the risk factor so that it will avoid the exposure to the credit risk. So given all of this, we try to, there are many studies on predictors of bankruptcy, but what we try to understand is what is the firm doing before going bankrupt. We found one invisible action or event action and two visible actions to the rest of the stakeholders done by the promoters and the firm. So one of them is earnings management. What is the relationship between the earnings management and the bankruptcy? Can we predict bankruptcy by observing the earnings management? Second thing is, does it have an impact on the resolution at a later date after filing for bankruptcy? Second part is the financial distress on the balance sheet of the bankrupt firm. Can we start observing it much beforehand to predict that this firm is probably going bankrupt? And third one is, as I'll discuss while discussing the hypothesis, what is the impact of the auditor opinion dropping on the probability of bankruptcy and the resolution later? We know earnings management is one of the actions or the discretionary decisions taken by the management to alter the financial reports to majorly suit their objectives. There has been extant literature in trying to understand why firms manage their earnings and what are different ways the firms manage earnings, especially before going for IPO or various incentives. One strand of research says that the firms are engaged in earnings management because it will give them certain private benefits. But mostly firms manage their earnings to show consistent profits and smooth out any fluctuations in the earnings to present a favorable view of the firm. This is what I've been telling about what is the kind of literature available on earnings management or earnings manipulation. So I'll quickly move to the hypothesis. So first hypothesis, what I'm trying to understand is what is the relationship between the earnings management and bankruptcy. So every firm has various incentives to manage the earnings prior to bankruptcy. Managers change their accounting policies to increase the earnings, and failing firms also tend to manage their earnings. Extant literature says that the failing firms or the bankrupt firms, just before the bankruptcy, they tended to show a downward earnings just before filing for bankruptcy. There have been large negative accruals observed in the years before the failure, usually 3 years, usually in a time period of 3 years before a firm going bankrupt. And the manager shows high earnings inflation in the previous years. So extant literature also says that firms with higher probability of bankruptcy engage more in the real activities manipulation. That is because they have exhausted all the other opportunities in accrual earnings manipulation. So we expect that there is a significant relationship between earnings management and bankruptcy. At this point, we are not looking which different type of earnings management are they involved in and whether doing upward or downward yet. This is more interesting for us because most of the earlier studies have already discussed the relationship between the earnings management and bankruptcy. We are not bringing much there. But we found one paper which was very interesting for us. What they have done is they observe the relationship between the earnings management or all the actions before the firm is going bankrupt. Will it impact whether the firm is choosing for Chapter 11 or Chapter 11 in US bankruptcy? So we wanted to try to understand whether similar thing can be done in India, especially whether the firm will be reorganized or liquidated, and what are the intentions of the promoters in choosing the kind of earnings management they do. So if the firms are what we are expecting is if the firms are overstating their projected earnings, that means they're showing a better picture of the firm, that the firm can be salvaged or the firm can be reorganized and be continued to work later on. So also in order to protect their employment, most of the managers will try to inflate the earnings. All of these at the time of resolution of the bankruptcy will show that will increase the chances of the firm going for reorganization versus liquidation. But on the other hand, when the firm is trying to understate the earnings, what is happening here is they have their own motivations to understate the earnings, mostly to get greater concessions from the creditors, to convince the different classes of creditors to accept lower compensation, and sometimes also to exclude the junior classes of creditors while there is a resolution plan. While this is their motivation, it may also happen that because of the understated earnings, the committee of creditors or the resolution professional might move the firm to a liquidation instead of reorganization. So this risk of reorganization versus liquidation depends on what you are reporting even before the firm is going bankrupt, in the last 3 to 5 years before the firm is going bankrupt. This is something we wanted to majorly understand. So earnings management happens in every firm whether the firm is going bankrupt or not, but this is mostly an invisible variable. What we also wanted to understand is after the firms really cannot manage their earnings anymore, that is when the stress is visible on the balance sheet of the firm. Or obviously, logically it should. We wanted to understand whether that is actually happening. So we wanted to understand whether there are indicators of stress on the firm's balance sheet just before the bankruptcy, and we look at McKeown 1991. I will discuss how that is. Okay, here I have mentioned what are the different ways in which how do we identify the stressed companies. We look at McKeown 1991. They split the firms into financially stressed and other firms based on the 4 indicators on their financial statements. First thing is the negative working capital in the current year. Then what are the operational losses 3 years prior to filing for bankruptcy. Then deficit in the retained earnings in the last 3 years, and bottom line losses, which logically shows that the firm is stressed. So we say that after the firms manipulate their earnings, after they can't do that anymore, then the stress is shown on the balance sheet of the firm. After this happens, we also assume that we try to examine the impact of the auditors or the role of auditors when all of this is happening just before the bankruptcy. So especially in emerging markets like India, where the markets are in developing phase, there is higher promoter ownership, which leads to principal problems, alternative problems. There is inadequate oversight of the board. There is lax judicial environment. In such cases, auditors have to play a huge role in governing these issues. But when there is bankruptcy happening or the probability of distress happening, the managers want to compromise this position of the auditors by trying to gain favorable reports about the firm, they go audit opinion shopping to get that favorable opinion by appointing a new auditor to verify their financial reports. So since auditor is an important governance machinery or mechanism in India, we wanted to understand whether this change in the auditor just before the bankruptcy is that one indicator of the probability of financial distress or the probability of firm going bankrupt. In the fourth hypothesis, we examine the role of auditor change just before the bankruptcy on firm going bankrupt. So these are our 4 hypotheses. First, we are trying to understand whether there is earnings management before the firm is going bankrupt. When the firms cannot manage their or manipulate their earnings anymore, then the financial stress should be visible on their balance sheet. Simultaneously, probably the firms or the managers will go audit opinion shopping just before the bankruptcy. These are our hypotheses. So this is our empirical model where we are trying to understand whether the firm is going bankrupt or not. The dependent variable is bankrupt, taking the value 1 if the firm is going bankrupt, 0 otherwise. Then we look at various earning management measures, stress as defined by McKeown 1991, and we look at whether there is an auditor change. These are our important variables that we want to observe. So data sources, we have looked at the bankruptcy filings available on IBBI website. Data is available from Jan 2019 and we match it with the financial information that is available on CMI Progress DX. As is practice, we exclude the financial firms, utility firms, and state-owned firms, firms with missing data. We match all of these firms. We have both the listed data and the unlisted firms of the listed and unlisted firms. The problem here is there is a huge loss of data in this particular setting, especially because most of the firms that are going bankrupt, at least most of them are unlisted firms, so a lot of information is lost. Most of the information is not reported. That is one problem that we have faced. So the data is venturized at 1% after filtering everything. For earnings management, we look at both real earnings management and accruals-based earnings management. For accruals-based earnings management, for the start, we have looked at Ditcher and Ditcher. And we also looked at Ball and Shivakumar. I'm sorry, the results are not visible. But what we have done is first trying to understand the relationship between earnings management and probability of distress, or the firm going bankrupt, dependent variable being 1 and 0. In columns 1, 3, and 5, we look at what is happening to okay, we run a panel regression. We also do a logit and a probit regression. Logit and probit because the dependent variable is binary, 1 and 0. So what and we also look at the earnings management in the last 3 years. Looking at Ditcher and Ditcher, we find that in the last 3 years, there is a positive relationship and significant relationship between the earnings management and the or the bankruptcy. Similarly, we run the analysis, repeat the analysis with Ball and Shivakumar 2006, and we find similar results. So overall, we find that accruals earnings management is done by the firms before they are going bankrupt. Next, we also test the role of real earnings management before the firm is going bankrupt. Again, we look at the last 3 years, and interestingly here we find that none of the previous years the firms engage or involved in real earnings management, which was very interesting for us to see that firms choose accrual earnings management before going bankrupt and not real earnings management. Next, we are trying to understand is the financial stress visible on the balance sheet. Again, similar analysis, dependent variable being bankrupt, 1 or 0. Then independent variable is firm stress calculated using McKeown 1991. Interestingly, here we find that there is no significant relationship between the firm stress and the bankruptcy, which was very surprising for us because at some point before the firm is going bankrupt, it has to show certain stress on their balance sheet or somewhere. But interestingly, we find there is no significant relationship. So what we are trying to understand is that the promoters or the firms are managing their earnings till the end, that there is no stress visible to the external stakeholders. Which is again looking at Satyam case also, it is the promoter who came up and showed that the firm is under stress. So probably that is happening in India where earnings management is a major indicator than financial stress. Or probably we have to find the newer indicators of financial stress to see, to find the relationship or how the firm is functioning. This is something that we have to understand. But again, the measures that we have used are very logical, even though it is a very old paper. We do not know why this is happening. That is something we'll explore further. Next, I was speaking about the role of auditor change, or whether the firms are going for audit opinion shopping before firm is going bankrupt. There is a significant relationship, positive relationship, but it is not that significant that saying that the firms which are going for auditor change means that the firm is probably going to go bankrupt, because after Satyam, there was mandatory auditor change, the regulation that came in place. So at least now we are not able to differentiate between whether that is impacting and that is why we are not able to see any results at this point. But audit opinion shopping has a very weak significance. So these are our major findings. So implied findings, these are preliminary analysis like I've just said. What we see is there is earnings management before bankruptcy, at least in the last 3 years. We have to understand a way on how to choose the time period before which there is major earnings management happening. Next, we see that it is the accruals earnings management that the firms prefer over the real earnings management. Most interestingly, we find that there are no signs of financial distress on the balance sheet of the bank of the firm. Like I just said, what are the other indicators of stress? Can the regulators or researchers come up with other better indicators of stress to understand, which can predict bankruptcy? Then auditors play an important role, but here audit opinion shopping again, probably we'll have to go further and examine further. So going further, what do we try to understand is first go for a better methodology where we do a propensity score matching, match the firms which are going bankrupt versus which are surviving, and see the robustness of our results. We also have to test for control for endogeneity. Second hypothesis that I was speaking about, whether the firm will be liquidated or will go for a resolution based on the earnings management. Though we have tested, the problem there is we have lost a lot of data. Whatever results we are finding, we are not sure if we can report it at this point. So we'll have to work on that further. But we find that most interesting part of the paper, where the promoters choosing overstating their earnings or understating their earnings, whether it will impact the choice of resolution plan chosen. Then next we also want to understand, for now we have only looked at auditor change. What we have to understand is whether the firms move from Big 4 to non-Big 4 just before going bankrupt. That is something that we want to test. Then next we also want to understand whether there is upward or downward earnings management happening when in the prior 3 years that we have tested. So these are our findings. I'm open for questions and any suggestions.
Let's see, questions.
I have a question. I'm a chartered accountant, so maybe I'm a non-Big 4 chartered accountant, so you may take it as a last question.
Yeah.
Are you very frank?
Yeah.
Your second last statement, Big 4 auditors provide higher quality audits and constrained earnings management compared with other non-Big 4 auditors. Is it a hypothesis or a statement?
This is coming from the literature. We have not tested yet. But most of the extant literature. Yeah. No. That is the problem. In India, at least, we do not find any paper recently.
Particular paper is it India? Which paper exactly? Possibly I was there some.
I'll share it with you.
Surely, madam. Because with due respects, I'm not again putting a Big 4 and non-Big 4. The biggest scandals in the world have happened where the auditors are Big 4.
Yeah.
I'm a proud Indian chartered accountant. A good chartered accountant or an honest chartered accountant could be a Big 4 or not a Big 4. There could be good and bad both in big and small firms or mid-sized firms. So this statement per se, I'm unable to digest. So with due respect with my biases, but I'm making this clear.
No, we are looking at the exact literature that has been reported, mostly in most of the Anglo-Saxon economies. So
parliamentary committees in advanced countries which have absolutely questioned the Big 4.
Yes.
So regarding the identification auditors change.
Yeah.
So auditor can also be changed because of the statutory requirement.
Yes, sir, exactly. So this is something that we were not able to control. How do we control for it is something we are facing. Because that is what I was saying. Okay, here I have not mentioned, but auditor change can happen because of the statutory regulation that came in place, and our time period is at around the same time, starting from 2017.
Yes. Anyone else? This question.
How do you define earnings management from the balance sheet?
So we have looked at, we didn't do anything much, so we have looked at the existing literature on how the earnings management is calculated. We looked at accruals earnings management, where it is the non-discretionary expenses reported by the managers. We follow DICHER and DICHER 2002, and then we also follow Ball and Shivakumar 2006. So from there we calculate the accruals earnings management, which is the error term. Yeah. We also test for the real earnings management also, but the results are. Sorry? No, it is not directly available. We have to calculate it from the existing methodologies.
Okay, one more question.
Yes, sir.
So for financial stress, why don't you look at Altman's Z-score?
Okay.
Wouldn't it be better than the independent numbers you have taken?
Okay. Maybe,
Might get some
yes.
result there. Yes.
Altman Z-score is, he is able to predict only 1 year in advance.
Yeah, we can take that, no?
Yeah, but then in case if the companies are in severe distress, 1 year ahead prediction will not be that's efficient for the companies. Maybe it is also one of the good models.
Can be made a time series, no? 3 years, 2 years, 1 year.
You can do
Mainly for 1 year prediction.
Madam, I've tried Altman Z-score. First of all, we have to slightly tweak that. country specific, industry specific, and the deterioration over a period of time as an indication. Maybe the exact score may not match, it may vary from industry to industry. I'm not taking the names of that industry. There are particular industries where every company is shown under distress by ordinance Z score. But if you adjust that to particular industry in this particular country, then you get a safety zone. That above this, the company in that particular industry does not come under stress because that is industry specific. Maybe when the investments are high, also it is in service sector, you have to adjust like that. And after a particular score, even the biggest names would come under stress over a period of time. That is my experience.
Right. And now there are several versions of the occupancy score for emerging market, for the industry, for the banks. So you can just Google and figure it out. What is the best for you? Yes, sir. There's a question.
Okay. Have you been through Gopalan and Martin paper which examines bankruptcy and earnings management?
Yeah.
Have you been there?
Yeah.
So how do you differentiate your paper from these papers?
I'll have to check that paper once again. I don't exactly. Can you tell me what are the results of that paper or the hypothesis?
They found that before bankruptcy filing, firm do this earnings management.
Yeah.
They start before 3 years.
Yeah.
So
okay, what is the difference from there?
Yes.
So though we have tested only this, so what I was saying is, we are more interested in what is happening after the firm is going bankrupt during the resolution process. Though I have not presented the results because there's a lack of data or the loss of data. So we are trying to differentiate from that.
After bankruptcy,
Yeah.
definitely it will be in the hand of IRP.
Yeah. Yeah.
So management can't do anything.
No, at that point management can't do anything. What we are trying to just see is, after it has admitted into the insolvency process, you can either be liquidated or reorganized. So before going bankrupt, the firm has been managing earnings for a while. So if it is managing their earnings upward or downward, based on that, we are trying to see whether the firm will go through the resolution or the liquidation. And what are the negative effects of it if they are trying to, if the firm is doing well, but they're trying to report their earnings downward.
Trial literature shows that in the context of India that there is
no, I don't.
Martin paper, please.
I'll check that. Yeah, thank you. Oh, thank you. Any more questions?
So your sample is all prowess firms, is it?
At this point, yes, sir. So yeah.
And so when you calculate the earnings management, do you adjust for the performance, because these are for firms that don't perform very well and their accruals don't show the same relation that other firms have?
At this point, I haven't controlled for that, so I'll adjust for that. Yeah.
And can you tell us why you chose these 3 factors to study?
So it basically came from discussion, not from literature as such. So what we are trying to say is, there will be, what are the promoters going to do just before the firm is going bankrupt? We know that the firms are going to manage their earnings, but any firm will manage their earnings and make corrections later. So first thing is there at some point that there will be higher earnings management just before the firm is going bankrupt? That is one. Second thing is, after they can't manage their earnings anymore, what are they going to do? At some point, it has to be visible on their balance sheet or any other financial statement. At least in other countries, we find that this can be one predictor of bankruptcy, where you look at the firm's stress. But in India, we thought, can that be one of the indicators? But we see that there is no significant relationship before the firm is going bankrupt. So that was the major. Then after that, again, once the firm stress is probably going to start being visible on the balance sheet, how is their relationship going to change with the auditors? Are they still trying to, will they still try to manipulate, or will they just go and give up? That is something that we wanted to understand.
Ma'am, when you are saying a manipulation, has there been any regulatory action taken against the auditors on basis of which you say there has been manipulation?
No, so only major thing that we see is when Satyam happened. Here. Sorry? PwC, it was only banned for 2 years.
So we should continue in this slide.
Okay.
Next papers.
Yeah.
Reforms, bankruptcy filings, reforms in the bankruptcy law and stock price crash risk of non-bankrupt firms. As is evident, my research is basically on the spillover effects of bankruptcy filings on essentially the non-bankrupt firms. So I'm looking at bankruptcy filings both pre as well as post implementation of the IBC. Now the literature clearly looks into the spillovers of bankruptcy filings through a number of aspects, such as the accessibility to debt, the cost of debt, or the investment levels. So we found a research gap that there exists lack of papers which look into another additional dimensions, such as the stock price crash risk of the non-bankrupt firms. So what generally happens as a negative externality of bankruptcy filings is that the non-bankrupt firms in the same industry find it difficult to access debt, and even if they access debt, they have to do it at a higher cost of debt. And subsequently, there is also a reduction in the investments for the non-bankrupt firms. So these are some of the negative externalities. So what generally happens when there is when there are these negative externalities is that as a result of bankruptcy spillover, there is a contagion which leads to financial distress of the non-bankrupt peers as well. So what happens as a consequence of the financial constraint or the financial distress of the non-bankrupt peers is that they start delaying or start withholding the bad news so as to not exacerbate the matters further, because they are already constrained of additional debt. And additionally, the managers of such financially distressed non-bankrupt firms, for the sake of their career advancement, they also contribute to delaying or withholding of such bad news. So this is where my motivation comes from, to see whether such delaying or withholding of bad news by the managers of such financially constrained non-bankrupt firms lead to any increase of their subsequent stock price crash risk. Now, just to put things in perspective, a stock price crash risk essentially means a sudden deep fall in the prices of stock prices whenever we withhold bad news and reveal all of them at a suddenly, all of a sudden. So this is what essentially stock price crash risk means. But having said all these, we see that whenever there is a bankruptcy reform or whenever there is a strengthening of creditor rights, what exactly happens post that is the otherwise financially distressed firms find it easier to access debt. So in the specific context of IBC, Bose, Philomeni and Malik 2021 paper finds that post the implementation of IBC, which happens to strengthen the creditor rights, there is an increased access to credit, and at the same time the cost of credit also decreases. Similarly, the non-bankrupt firms increase their risk taking and also increase their profitability. So this is the paper by Singh, Chauhan and Jadiappa. The author happens to be present amongst us. So based on this background, my objective of the study is to see whether filings of bankruptcy induces any contagion, because of which there is an increase in the stock price crash risk of the non-bankrupt industry peers. Secondly, in the context of implementation of creditor in control bankruptcy regime, we also try to find if it has any mediating or a moderating role on the stock price crash risk of non-bankrupt peers. And lastly, I also try to examine if there are any firm-specific characteristics which kind of insulates the contagion effect of bankruptcy spillovers on the crash risk of firms. So these are the overarching objectives of our study. Now, to just give you an overview of findings, what we find from our study is that, so whenever there is bankruptcy filings, or so to say clustered bankruptcy filings, there is an increase in the stock price crash risk in the subsequent year, number one. Number two, we see that when there is a change in the bankruptcy regime from a debtor in possession to a creditor in control bankruptcy regime, we see that the stock price crash risk in general decreases during the creditor in control regime. Thirdly, we find the domination of free rider hypothesis when we say that more the number of lenders of a firm, more is the stock price crash risk of such firms. And lastly, we see that firms in which the promoters are majority shareholders are able to insulate themselves from the bankruptcy contagion in the form of increase in stock price crash risk. So these are essentially the findings, overview of the findings of our study. Just to give a small gist of the literature, we see that one of the seminal papers in the work of stock price crash risk is Ginn and Myers, who see that the major precursor of stock price crash risk is sustained withholding of bad news. So whenever a firm tries to withhold bad news for a considerable period of time and reveals all of them at a sudden, if we take the example of Satyam Computers or Yes Bank, so there was, the firm was not in a very good shape and they have been hiding or concealing all the bad news for a sustained period of time. And when they revealed it, we saw that the stock prices crashed. So that is one of the major precursors of stock risk. It is also seen in the Kothari et al. Paper 2009 that managers, for the concern of their careers, are also instrumental in delaying or withholding of such bad news. And generally when it comes to bad news, they delay it more as compared to any good news, quite intuitively. And then we see that whenever there is an increase in financial distress among firms, it leads to an increased stock price crash risk on the basis of mechanism that I explained in the earlier slides. And we also see that some firm specific attributes like firm opacity is positively related with the stock price crash risk. For the sake of brevity, I am not alluding to the literature that relates the monitoring aspect of the stock price crash risk of firms. But we see that there exists two conflicting hypotheses in as far as the monitoring is concerned. One sliver of literature says that if a firm is monitored by more number of lenders, or if there is a presence of lenders on the board of such firms, it leads to more monitoring and consequently there is less stock price crash risk. Conversely, the free rider hypothesis states that more the number of lenders means more chaos, especially when the firm is financially distressed, and each firm would want to have a larger pie in the recovery, and there is lack of coordination among such lenders, which leads to an increased stock price crash risk of such firms. So we test whether the free rider hypothesis prevails or the monitoring hypothesis prevails. So these are some of the hypotheses that I'm going to test. These are the hypotheses. My first hypothesis is whether non-bankrupt firms and industries witnessing multiple bankruptcy filings would experience an increase in the stock price crash risk. Second, I test whether the introduction or implementation of IBC, which is a creditor and control regime, moderates or lessens the effect of the bankruptcy contagion. Thirdly, I also look at firm-specific characteristics like the total number of lenders and hypothesize that they will, under the monitoring hypothesis, I hypothesize that it leads to a decrease in the stock price crash risk, and conversely, under the free rider hypothesis, I hypothesize that it leads to an increase in the stock price crash risk. Now, before I move on to the further slides, I would like to emphasize on why I look at multiple bankruptcy filings. So, there is another sliver of literature, including Herzl and Officer 2012 paper and Chang et al. 2020 paper, which says that as compared to idiosyncratic or isolated bankruptcy filings, multiple bankruptcy filings or filings that are clustered in a period of time in an industry have a magnified or more pronounced contagion effect on the non-bankrupt peers. And that is why I am also keen to look at whether such clustering or multiple bankruptcy filings in an industry year would have any pronounced effect on the stock price crash risk of the non-bankrupt firms. So as far as the data and methodology is concerned, I divide, my subsample period is from 2009 to 21. That encompasses essentially two bankruptcy regimes. Prior to 2016, we had BIFR as our bankruptcy regime, and post the implementation of IBC, BIFR was discontinued, and we have IBC as the bankruptcy regime. So my industry clustering, or the basis on which I identify non-bankrupt peers in an industry, is based on Pharma French 48 industry classification. As far as clustered filings is concerned, I'll just like to take a minute more to explain this. So when I look at bankruptcy filings either under BIFR or under IBC, I look at non-bankrupt firms belonging to the same industry in an year, and whenever an industry witnesses one or more than one bankruptcy filing, I term it as clustered filings, provided the industry witnesses filings in that year as well as the subsequent year. So that is what I essentially mean by clustered filings, because the industry witnesses filings over a period of time. So this is my main explanatory variable. Apart from clustered filings, I also quantify the number of filings witnessed in an industry year, which I term it as number of filings as an alternative explanatory variable measure. So this is as far as the data and methodology is concerned. I collect the firm specific financial data from CMIE ProVes. So my measures of crash risk is essentially dependent on the often used crash risk measures as per the literature. First is the negative skewness, and second is the Duval, which is the ratio between the downward and upward volatility. I take the extended market model, wherein my weekly specific return of firm I for the year T is regressed on the market returns, wherein which I have taken BSE S&P 500 returns. And I also, to account for non-synchronous trading, I use T-1, that is the prior 2 weeks and the lags of 2 weeks and leads of 2 weeks. The error term is then added with 1, and we take the firm specific weekly return, that is the capital RIT, as log transformation of 1 plus the error term, which we use in the calculation of NC skew and the Duval models. Now coming to the results, if I could minimize this or transfer this, just a second. Okay, bring this down. So I have highlighted the portions where I want to draw the attention with regards to the results. So my explanatory, in the first 3 columns, my dependent variable is the lead value of the crash risk, that is the NC skew, and I use the lagged values, that is clustered filings during the year T, IBCs T, and all these control variables for the year T, whereas the dependent variable is for the year T plus 1. My bad that I did not include those notations in the table. But in the first column, I do not use two control variables, that is the firm opacity and the number of lenders. In the second subsequent columns, I go on adding one control variable, that is the firm opacity, and in the third column, I again add the number of lenders. Similarly, the case for the other dependent variable, measure of dependent variable, that is the Duval. So what I see here is that clustered filings is having. So the results show that clustered filings is having a positive and statistically significant coefficient, which means that the future stock price crash risk, when it is measured in both in terms of NC skew as well as Duval, increases whenever there are clustered filings in an industry. The coefficient for the dummy variable IBC, which is indicator variable with value 1 for the IBC years, shows that there is a negative relationship, indicating that the stock price crash risk of non-bankrupt firms decreased during IBC regime. And then we interact the clustered filings with IBC, which means that even during IBC, when there are clustered filings in an industry, my stock price crash risk of non-bankrupt firm still decreases. And in accordance with the existing literature, it shows that firm opacity is positively related with the stock price crash risk, which finds support of the existing literature. I measure firm opacity by Amiut's illiquidity ratio. And number of lenders is actually the absolute number of lenders that a firm is availing credit facilities from, a data which I get from the CMIE ProVes. I use all the other control variables apart from using the lagged value of the dependent variable. In the next slide, so in the next slide, I look at the interaction between the number of lenders and clustered filings. And I see that there is a statistically significant coefficient. So in contrast with my earlier findings in the previous slide, where I find that there is no significant relationship between the number of lenders and the stock price crash risk, contrasting to that, in the next slide, when I interact with the clustered filings, I find that there is a positive and statistically significant relationship, which means that there is a dominance of the free rider hypothesis, which means that the number of lenders is actually problematic when the firms, non-bankrupt firms, are likely to face financial distress because of the coordination problem. In the next slide, I look at the alternative measures of my explanatory variables, which is by number of filings, which as I have explained, it is the absolute number of bankruptcy filings an industry witnesses in a year. And again, we find that for both NCSQ as well as Duval, we find the same relationship as we have found in the earlier tables. Similarly, I also, as another measure of the explanatory variable, I use industry bankruptcy as an indicator variable with value 1 if it finds any bankruptcy in a particular year and 0 otherwise. And even for this measure, I find that there is a positive relationship between the stock price crash risk and the explanatory variables, and the interaction and the IBC coefficients remain the same as per the previous tables. Now I divide the sample on the basis of promoter holdings with more than 50% and promoter holdings with less than or equal to 50%, and I find that in the third row that there is a decrease in the stock price crash risk of firms in the IBC regime for such firms where promoter holding is more than 50%. So this essentially means that whenever there is a convergence between the objectives of the promoters and the managers, there is a reduction in the stock price crash risk because there is less withholding of bad news. So there is this again finds support of the existing literature which looks at monitoring hypothesis, which states that firms with higher promoter holdings are actually less prone to financial distress, and that explains the negative relationship between the stock price crash risk and the promoter holdings. In the next subsample analysis, I account for the macroeconomic shocks such as the asset quality review by excluding the sample firm year observations from the year 2015 to 17 to account for the fact that AQR was implemented during the period of which many banks were put under prompt corrective action. So we can say that due to the spike of NPAs during the period, banks would have been wary to lend. So we exclude such subsamples. We exclude such years and see that our observations remain the same even in such subsample analysis, thereby proving that our results are not confounded with such other parallelly running macroeconomic shocks. Similarly, we also exclude the firm year observations during the COVID-19 pandemic, wherein, yeah, just a second. So this is the second last slide, and yeah, so we have accounted for most of the robustness to make sure that our results are not actually affected by any other factors. So thank you. I thank IBBI and IIM Bangalore to give us an opportunity to present our paper. Thank you.